Good morning, good morning. Just as you thought we were going into a quiet Friday, boom, the headlines hit last night. Rio Tinto and Glencore talking about a potential merger. That gave me the rush of excitement I haven't had since 2006, Minnie.
2006, that's a long time ago.
2006. So, yes, talks are no longer ongoing, but we're going to cover a whole section on Rio Tinto, Glencore, what you could have traded last night, what you shouldn't have traded last night, and look at what were they doing in the first place. It's an interesting.
Yeah.
Good morning to you. First of all, we've got to talk about this hair. What the hell is going on there?
Yeah, so I had curtains initially, and then I had a comb over. So I had curtains for 3 or 4 years. I had a comb over and it didn't really suit me. So I decided to get my hair done.
Done?
Well, I say done. Attacked. Don't say that. Quite short. However, I do like it, but I sort of regret it now because I didn't realise having such short hair means that when it's cold, it's so much colder. So I've been having to wear a beanie.
Right.
Yeah.
Brilliant. Well, there we go. Geez, you lot are active in the chat this morning. This is fantastic.
Love to see it.
Good, yeah. And on a Friday as well. I thought people, out
on a Friday.
It's because they're not drinking.
Oh, dry January. Are many people doing dry January?
It looks like it to me in this chat this morning. Are you doing dry January?
No.
Just no.
I'm out Wednesday, Thursday next week so far.
Fantastic. Well, I went out for a client lunch yesterday, first of the year with Ronnie. And the client that we took out for lunch is one of the nicest gentlemen I've ever met. A lot nicer than you lot on the chat here, eh? Talking about all the dinosaurs and the mammoths this morning. He was 86 years old. Christopher, a very good morning to you. But I learned so much. We hardly even talked about trading because this guy, when he was 4 years old, then he was in the basement at the end of, towards the end of the war. And the German bombers were dropping bombs on the coastline, not to try and bomb anybody, just to get rid of the bombs they hadn't dropped on Liverpool docks. And so he can still remember the noise of them. Just incredible. He was in Germany for the 1966 World Cup final as an Englishman.
Yeah.
And he was trading all through the, obviously, 87 financial crisis. Just unbelievable. What great stories. I'd love to get Christopher on at some time. But yeah, very good morning to you. But a good morning to you all as well. Already, they're talking about your hair. Monkey Man, AP, Carl Wolf, good morning. Getting all paranoid now. What's the verdict on Mini Cooper's hair? Should he grow it again? Should he wear a hat? You look like a bit of a... If I saw you in a dark alley, I'd be a bit worried you're about to mug me.
Oh, what about bald?
Skinheads. Yeah, or what about a straight razor? AP, the curtains were shocking, look. You now look like a Mitchell on EastEnders.
As in Phil Mitchell?
Yeah, he's too young for Phil Mitchell.
Isn't Phil Mitchell like 40, 50 years old?
You will be now.
Sure he is.
Yeah. No, you don't. No, don't worry. They're not saying you look old.
Okay,
you look
that's
about
all
12. Lemur lad, a very good morning to you. Yes, back. Your favourite day of the week. Good to hear. AP, what a haircut. And right, let's dive into it. Enough of this chit chat. Let's get into Rio's Glencore overnight action. Right, what do you need to know? Well, about 7 p.m. last night, Pete Ward, my wonderful PCM, sent out a quick message saying M&A alert. There is talk from Bloomberg that Rio's and Glencore had held talks around a potential for a merger. Now, you can see from the Rio Tinto graph here what time it was. The ADRs initially jumped. I've got no idea. Clearly, just they saw Rio's M&A and then came right off. Let me get you into a 1 minute chart there. Yeah, it's not even much better. There we go. Right, so Rio's was trading 60.20. That's the ADR, so that's in US dollars. And then, of course, people realized Rio's would be the acquirer. They're worth 88 billion sterling, I think the market cap of Rio's. Glencore about half of that. And so if the deal was to happen, then Rio's would take a big hit because the Rio's shareholders would not be happy. Think about the culture at Glencore, right, with everything that they've been through, DOJ investigations and everything, and then the culture at Rio Tinto. Rio Tinto massively overpaid for an aluminium deal back in 2007, 2008, and paid for it for years.
Okay.
Now, we've got a commodity mix in Rio Tinto, which is majority iron ore, aluminium, a little bit of copper.
Yeah.
And we've got a commodity mix in Glencore that's a little bit of everything, no iron ore, but there's not obvious synergies. So it's not like you're even going to take out, billions of costs out of it. So it was, the initial story was a sort of feeling of why?
Yeah.
Why Mini Cooper?
I was reading how if it was to go ahead, it would be the biggest mining deal ever on record. Ever. Yeah.
That's right. So then you start to think, well, okay, why? What's the reason for this? And the reason is, of course, because BHP and Anglos were in discussion. So it's kind of like, are your friends getting married yet?
No. We make jokes about it, but
Have they got girlfriends?
a few of them actually. It's funny you say that. One of them sent a picture as a wind-up last night. I'm not sure who it was, but with a young lady with a ring on.
Oh, right. Okay.
Yeah, just as a wind-up.
It's-
Well, I think it's as a wind-up.
Perfect example, right? So over the next few years, Minnie, all your friends are going to get serious relationships and end up getting married.
Yeah.
And you'll still be sitting there single, all by yourself. You won't have anybody to go and hang out with, right? So you actually get to the point, you look around, you think, oh, I'm going to have to settle down, haven't I? I'm going to have to get myself a girlfriend. That's the position that Rio Tinto was in, right? So BHP and Anglos, if they had merged, the whole sector's in play. And so Rio Tinto and Glencore would be looking at themselves, both single, and thinking, right, is there something to do here? So they've clearly had early stage talks that are no longer ongoing, right? So I actually think there'll be very little trade to do on the open, right? If Glencore is up like 4% or something, it's ridiculous because talks are no longer ongoing. But we can have a look at the FT report here. Held talks very much in past tense. Now, this wasn't clear last night, right? So last night, it was inferred that talks, might still be ongoing. But the FT has the story that they are absolutely not. So they held talks last year about combining part or all of their businesses in an indication how to push the mining companies to secure metals needed for the energy transition. Engaged in early stage talks, right? Now companies, they talk all the time and we never know about it. So why Bloomberg thought it necessary to start talking about this, I'm not so sure. Why? US dollars, it would be just over 100 and 55 for Glencore. So 80 sterling or 88 sterling and 55 sterling. So yeah, the talks between the two companies followed BHP's failed bid for Anglos. Now, what it does do and what it makes it really interesting is what would the structure have looked like? And this is where the trade came in last night, that people would have been completely wrong to sell Rio's ADR.
Okay.
Because Rio Tinto has two lines of stock, as BHP did before. They've got an Australian line and they've got a London line. Now, the Australian line trades at a 20% premium to the London line. And that's for various reasons. Franking credits, it's called, so you get tax breaks on your dividends.
Yeah.
Australian funds have a mandate where they have to invest domestically. So a lot more of the money goes into the mining stocks than it does in the UK pension funds. But, that should be a, say, 12 to 14% premium. It's now trading at, well, we can show you. The way that you work this out is you take the London price, which is about 49.18, 49.30 maybe, and then you convert the Australian price into pounds, right? So that's taken $1 Aussie. The Australian price is about 119 after last night's trade. So you can see there's a huge difference here, right? It's about 21% between Rio's London and Rio's Australia. Now, obviously, you can't funge the two. You can't buy you can't buy an Aussie one and convert it, or the other way around. So they are two different lines of stock. Now, and chart off, thanks guys. What Rio management are under pressure to do is actually, and what BHP did was merge the two.
Okay.
Right, so you only have an Australian line of stock. Well, that's where it's really held now.
Yeah.
And Rio's is under pressure from the same activist that got BHP to actually go through with it. Right, so now Rio's is under the same pressure. What they would have done is issued stock in Australia, diluted the Australian line, and potentially collapsed the structure. So you would have had an equal parity of London line and Australia line. That 20% gap would have come right in. Okay, so by shorting the London line, you'd actually be shorting the line, which would benefit by up to 10%.
You don't want to be doing that.
It would have been a disaster. If it had been suddenly announced this morning, then, and it would have been announced with Australia doing, so it would have been Australia line in a vast majority
That closed
cash.
at 7 in the morning UK time, and then of course we would have opened at 8, so it would have been closed for an hour.
So it would actually have been genius because, you know, Rio's, what might make it more apparent now is that Rio's are thinking of potential ways, not just to become one of the major players in the world, but also thinking about ways to collapse this structure, keep the activists happy. They've got a further complication in that the Chinese own, I think 19% or 14 or 19% of the company, because they came on a dawn raid, it was called.
A dawn raid?
Back in 2008. A dawn raid where the Chinese came to us and they said, right, we want to buy 10% of the company. And this was, you know, at sort of 11 p.m. at night. How much do you want to sell? And they came in and they bid £60. And it was a way of getting in between a Rio and BHP merger.
Okay.
So it was like, well, the stock was trading at 50. Exactly where it is now, actually. And we were like, yeah, okay, sell $10 million, but we should have done $100 million because the stock was up 5%. So it went to 52, 53 pounds, and you were short as 60 pounds. It was the biggest free money you've ever been given. Right, producer Fred's put together a wonderful pie chart for us. Let's look at how Rio Tinto revenue looks. That big green section is iron ore, right? So as a percentage of revenues, Rio Tinto is 66% iron ore. Glencore does not have any iron ore. So, you know, that makes it interesting as terms of diversification.
Yeah.
But with China potentially slowing down and the iron ore market in, you know, oversupply, let's say, you've got a real potential. Rio Tinto are shitting themselves because the demand for iron ore and the price of iron ore is going to drop, right? So they've got to find ways to keep themselves relevant. And they've looked at going into sort of new age energy, like lithium and things like that. And this is Rio's revenue from a couple of years ago, so it's not exactly up to date, but the vast majority, you get the idea. It's iron ore, it's aluminium, and it's a little bit of copper, and now lithium. Let's look at Glencore now. And you can see there's very, very little overlay, right? There's copper, which is what everybody wants. Copper is the number one sought after revenue metal. Then you've got zinc, you've got nickel, you've got ferroalloys and precious metals. You've got thermal coal, which they don't know what to do with, right? So that blue segment at the top, they're actually trying to get rid of it. And they thought about spinning it off. They thought about selling it. So that would be a problem because Rio Tinto just got out of thermal coal. So they've got no interest in going back into it. And that's one of the clear things. Thank you very much for that, producer Fred. He's been hard at work on those, isn't he?
Too right.
That is, you don't
Very
get
impressive,
that.
Fred.
I bet you Bloomberg haven't had that up this morning.
Definitely not.
Yeah, one of the main sticking points in the deal is Rio Tinto shareholders say, what the hell are you buying a company that's got 19% thermal coal when we just got out of it and we don't want to get back into it? No. So there's a lot of reasons why this wouldn't happen, but it does underline one important thing, and that is the main takeaway for me this morning. Mining companies are desperate to cover themselves for the lack of investment into their mining operations in the last 5 years, right? You do not have new production coming on. So BHP, desperate to buy Anglos to get that copper resource. Rio Tinto, desperate to expand their operations outside iron ore. So they even looked at Glencore. I mean, let's talk about dancing with the devil, right? So there will be more M&A in this space. You just don't know who, and you don't know when and what the targets are. The first thing I did last night was jump into my copper miner ETF. So this thing here, Global X Copper Miners ETF, I bought that straight away because I thought, right, if we're getting M&A, that means, well, first of all, it's got 5% Glencore. So Glencore would have been up 20%. Then I also bought Freeport-McMoRan, so that's a big copper producer. And that was in the States. It's pretty much all I could do. I wasn't about to go and buy Glencore ADR up 4%. You know, it was interesting. But what it does do for me is it really underlines the need and the demand for copper mining and copper in particular. I did hedge it with a little bit of short copper because I went quite big on that copper ETF. So yes, right. Sorry for the huge ramble, but I just think that would have been the biggest story of the year potentially already happening in January.
Yeah.
And we are going to hear more. So knowing that background of Rio's problem with its structure in Australia to London, that premium should come in now. So you might actually see Rio's go up on a story like this, Rio London, and you might see Rio Australia come off.
Yeah.
So that's one to watch. The other miners, of course, in the area. What's Glencore going to do this morning? I actually can't wait to find out.
Got 12 minutes.
We got 12 minutes, the anticipation. Right, Minnie, do you want to run us through the few other things that you've seen this morning?
So this morning there's not much, but I was going to talk about what happened earlier in the week. So we had US CPI and UK CPI. Now, off both figures, the market actually reacted very, very well.
Yeah.
So with US CPI, it was 2.9% year on year. Okay. Now, markets did react well, and we've got the next rate decision on January 29th. Like I said before, I'm thinking with the US and with Trump's policies being very inflationary, with the tariffs, I'm not really sure how much opportunity the Fed are actually going to get to cut these rates.
Yeah.
Whereas here in the UK, it's a different story.
Well, it's almost desperate here in the UK because we've had retail sales this morning that are horrific. So let's look at those retail sales because, all right, we knew that retailers are under pressure, but look at this figure of minus 0.3 in the most important month of the year.
Shocking.
I mean, this is like you having your review next week, and today's the day you make a massive F up. You know, there's important times of the year you don't want to see weak sales, and that is going into Christmas. So that minus 0.3 against, expected up 0.4. Gives us a big miss year on year as well, 2.9%.
I mean, as of yesterday, here in the UK, there was after that CPI figure, there's an 83% chance of a rate cut.
In the UK?
In the UK, right. Yeah.
And that's why we're seeing sterling come off.
And whereas before this CPI figure came out, it was quite a bit less than that.
Yeah, great. Monkey Man, not sure about the change of colours between pie charts for the same iron ore. Producer Fred is hanging his head in shame.
Oh, I can see Fred from here. He looks a bit upset now.
He's the header in the hands. Sacre bleu.
Good French accent.
Right, so there is no Apple for teacher there for Fred. But let's have a look at what happened to Apple last night in the States. Smashdown. Apparently, Apple sales in China are in retreat, and there's a report yesterday, they've become the number 3 in China. Not number 1, not number 2, number 3. So that hit the stock. We can see on those big moves yesterday, down 4%. That took Tesla down with it as well, down 3 after opening up. I think it was up pre-market.
I mean, Tesla haven't been doing too well in China either. So that may potentially be the reason why.
Yeah, well, the whole NASDAQ beating at long last. We see NASDAQ having a terrible day yesterday. And what is this morning we're seeing here? The FTSE 100. Is that a breakout? Are we going to see the FTSE? Look at that. 84. First of all, it was up overnight, which was incredible. But now we're seeing it up at 84.64, which is incredible. I actually had shorted some, and I'm strongly regretting that now because we're at a level which we look at that. We're right on breakout, Mini Cooper.
Love it.
How excited are you about that this morning?
Well, I'm excited it's a Friday, but I'm now more excited about this.
Oh my goodness, we're about 12 points away from the level of breakout on the FTSE. Axel, do we have Axel on today, producer Fred? Oh, we might need to see if we can have we've got Chris Beecham. Chris Beecham, no doubt, will be the puppet of Axel, the puppet master. And he'll give
puppet of Axel. I'm not sure we'd like that.
Only when it comes to this morning in the FTSE, not in general. We're gonna see some real interesting moves in the FTSE here. If this is a breakout, then we're talking about what we've been waiting a year for this, a year and a half. When was this? This was May 24 that we've done absolutely nothing. And we're back to those highs today.
So in the FTSE, they had a good 3 months in 2024, but the rest of it really wasn't too great. Whereas when you look at the US indexes, so NASDAQ, S&P, Dow, I mean, they did well the whole year.
Right, so that's ours. I'm very excited by this morning. Very excited. There's so much to do on the open. I mean, the mining stocks already. Let's have a look at the way the mining sector. So I go to European sectors and then basic resources. It's a little bit tricky because it doesn't take sterling into consideration. So you can see there, that's about a 6-month chart, and it had been up in the highs of September and has come right back. So yeah, I fancy that. That's the one I'm going to be involved in this morning because, well, I just thought I'm going to have to see if I can get some orders into the auction. Right, Angeline filling up the chat there. I can't see what you guys are saying because Angeline's so chatty this morning. Funky Gibbon, will Vodafone finally be mobile on the upside? Very good. Funky Gibbon, we're going to have to get you into the studio at some point. You can be our official joke master.
Take over from you.
Well, yeah, we know those jokes are running dry. I think I've used the same ones.
Especially on Pete Ward.
Especially on Pete Ward. Yeah. No, there's Yeah.
Do you know what? So much I actually feel quite bad for Pete.
Do you?
Yeah.
Is that because he's your boss?
Well, sort of.
Is that review next week?
Well, we've already had it, so I'm fine for now.
Good. And that's why you chopped all the hair off? New you, new year.
Too right.
We're going to take a quick break and we'll be back for this most exciting open of the year so far.
Are you ambitious? A future leader? Do you think big and raise the bar? If that sounds familiar, IG wants you. We're a global fintech and we offer graduate schemes for the ambitious. You'll see everything as you rotate across the business, building your skills and knowledge as you go.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Right, welcome back to this momentous day. We're about to see a FTSE potential breakout, or are we? Could be helped by the mining stocks this morning, could be helped by BP. We had the BP story yesterday on big job cuts. Feels a little bit like this was the CEO defending himself after bad press earlier in the week. The poor guy was in for an operation, and then the FTSE started talking about his job being under pressure. It's a bit harsh, wasn't it?
Very harsh.
So yeah, we see big job cuts potential from BP. That's all across the Times this morning. How are the retailers going to do? That's another one to look at. The retailers could be in a bit of problem with those retail sales. Now you can see here's the BP axing thousands of jobs in a 2 billion cost-cutting drive. It doesn't sound like it's anything new. It sounds like a story that's been wheeled out by the CEO to kind of, not save his job because it's not under pressure, but to alleviate the media, negative media talk on him this week. So if you actually read it, there's not any real new job cuts there. So we're going to be watching that. Is there any upgrades, downgrades? We're going to get good old John McGuinness to tell us about that. We've got 15 seconds before Minnie's about to ring that bell. get us undergoing. Are you excited, Minnie? Oh, he's gone early.
I was just testing it.
The London Stock Exchange is just like, go. Right, I've got some orders in Rios at Monkey Man. You're not front running me in this again. Yeah, let's see where Glencore is going to open that. Well, let's get the actual mining section miners up. Right, here we go. Here's Rio Tinto up 1.1, Glencore up 3. That's about the right move, I think. There's no way it should be up more than that, even though it is £3.80. And Glencore below £4 is always interesting, especially with the move in copper. We're getting a breakout in copper. We're getting a breakout in the FTSE potentially. So I'm not going to short that because, okay, I don't believe the story. The story's not going to happen, but still, it highlights that Glencore's £3.80. Rio's up 1. I'm glad to see that's not down. I'm still tempted to have some of those. Anglos is Anglos is the one I'm going to take some of because it highlights potential M&A in the sector. So I think that one might see some more life. Copper 447 this morning, so the sector should be up anyway. Anything else jumping out to you there? Antofagasta up 2%. That would never get bid for because that's owned by a family, huge family stake. So if I was going to hedge something, it would be that. In fact, I'm going to put a sell order in there just to get a bit of a hedge going. So responsible trading after all, Minnie, right?
Very responsible.
So order at 17.75 if that one gets up there. Right, there we go. That's in. So we've looked at the miners. What else is happening on the FTSE with a huge breakout potential? Glencore up 3. If that's up 5, I would short some up 5 because I think that would be too much. But 3% is almost warranted.
You've got BP there as well.
Yeah, how's BP doing, Minnie?
1 point. Is that what my eyesight's getting a bit bad now? My old
You can
age.
walk up to
1.27%.
the screen if you want.
It's gone a quick wonder.
Go on, you walk up to the screen and you have a look at all those.
So that's 1.24% for BP. We've got GSK up 1.41%.
Shout them out, Minnie. Go on.
Rio Tinto up 1.41, Barclays up 1.36, Travis Perkins 1.23. We've got Lloyds doing well, another UK bank doing well, up 1.15%. We had the US banks reporting earlier in the week. All of whom did very well.
We actually wanted to bring Minnie back in vision there because he just had to walk up to the TV we've got in the studio and peer in to see. Now this is funny because Sosnoff did exactly the same the other day because they were talking. Sosnoff has to go up to the screen like this. I don't want to go down there because it showed my bald spot on air. But you're as bad as him.
You need to zoom in more. That's what it is.
So well, okay, I'll zoom in more. And once you give us a bit of value added, I'll zoom in. How about that?
That sounds fair enough.
Right, what's happening in Europe this morning? Do we even want to take a look at Europe? No, not particularly, because all the excitement is in the FTSE for once. Anheuser-Busch up 1.6, Siemens up 90 basis points. But let's have a quick check to see how... Glencore is getting hit down, so it's only up 2 now. I think this is more interesting for Rios than it is in Glencore. The FTSE, how is that traded on the morning? My God, it's at the breakout level. The FTSE, 8,472. Let's look at that. So we've got it open anyway. Let's get it on the minute by minute. Oh, I'm almost tempted to go tick by tick. that is the FTSE attempting to break out the 8,472 level. It needs to get up to about 76. 79 producer Fred is confirming. Let's see if we can get Axel live on a call to talk us through what levels are particularly important. He will tell us it has to close there tonight. That's the important thing, is of course at closing. Now, how are the retailers getting on? Because if there's a sob story today, it's going to be in that sector. UK retail, dreadful retail sales, even they're up. What's going on there?
That's crazy.
We get told that UK retail, I guess a lot of them have reported. So that sort of makes sense. But that feels like you're dragging up all the names by the UK being so strong. But maybe they are a little bit optimistic there. Yeah, we'll see. As long as Greg's up, who cares? 22.24 for the sausage roll.
Is that your go-to at Greg's? Is it a sausage roll? Is it a bacon roll?
Well, I'm not allowed ketchup on my sausage roll, so it has to be a bacon roll, Mini Cooper.
Who says you're not allowed ketchup on your sausage roll?
The manager of Greg's. Have you missed all this?
Yeah.
This was my outrage. We're going to do a live section one day down in Greg's, and we're going to take the camera in, and we're going to ask for ketchup. And you just see the frustration on my face. Right, I want to do something on the European sector ETFs because I'm very excited by this mining breakout. So let's get an order in there, 54.20. So no, why am I being a dick for a tick? Let's just buy it. Right, 400 bought at 54.30. Then I want to go into the retailers. Where's my retail? So, I mean, that is all of Europe. There's a UK retail ETF, but it's not very liquid. RETG it is, isn't it? Where are we? FTSE 350 retail. No. No, I'm gonna keep that as it is. I don't want to short retail when just on bad numbers. When a lot of retailers
at the moment.
And what? Sorry.
And it's looking very good at the moment.
And but I need a hedge. Do I just short the FTSE, or is that stupid?
Depends. What's your risk tolerance?
It's a very good
You're a risk
question.
lover? I'd say yeah.
In a situation like this, that I've waited for 7 years for the FTSE to actually outperform the US and been wrong for 7 years, I'd be a bit stupid to short the FTSE now.
Look at the bright side though, you get a higher dividend yield in the FTSE than you do on the US indices.
Yeah. But so I bought a lot of miners, right?
Yeah.
I bought copper miners last night. I've bought the mining sector swap this morning. I bought Anglos this morning. We are short Antofagasta. We just got taken out at 1775. So that's it. Boom. That's it's answered. So we're short Antos. That is, so this morning I have bought 700 Anglos and I've shorted 700 Antos. That could be, BHP could be the short. This morning, I would want to be long Rios versus BHP, and I'd want to be long Anglos versus Antofagasta, because Antofagasta will not get taken out because the family are hugely proud of that ownership.
Yeah.
And they're not going to give that up. Whereas Anglos, well, it's for sale, isn't it? Right, let's take a quick look at Greg's, £22.30. We're getting the big recovery that it was waiting for. That was the key thing to watch last week, was that that bottoming in the panic at £20.30. And you can see that it's now, I must admit, with the bad retail sales this morning and the fact that it's recovered £2 from where it was, I think I'm going to just put this one to bed and Oh, I'm hearing the gallery are thinking about selling theirs as well. Right, there we... Oh my goodness, the gallery have just... This sounds like I'm following the gallery doing it now. They've utterly rinsed me on this. He's only taken off part of his position. Is that half and half? 22.50. Oh, so he's put a limit. Maybe that's what I should have done. Yeah, anyway, that is my Greg's journey over with a grand total loss of about £600 when it was down 3,000 at one point. So I think I might have got away with that one. And there's other stories elsewhere to be watching. Right, Minnie, what have we not looked at this morning? Commodity prices. Do you want to go on, jump back up and take us through the commodity moves?
You know what? It's the light. It's the light which is doing it. So we've got all US crude. That is up 0.75%. We've got Brent crude up 0.55. Silver down.
Go on, go back live.
Sorry?
No, go on, carry on.
Silver 0.78% down. Spot gold 0.16% down. We've got nat gas down minus 3.05%. That's the biggest mover on the major commodities at the moment.
Do we not have camera 2 active? We need a wide shot here of our youngest lad in the company here, the Supreme Mini Cooper, walking up to a what size do you think that TV is?
That is around
50-inch?
49-inch, I'd say.
49-inch, all right, sorry, 50, I was way off. 49-inch television and standing a foot away from it to look at what the moves are.
It's because of the light, I think, maybe.
Oh, that's what it is, yeah.
And I'm like, the light makes it so the TV, unfortunately, gives me a reflection of you.
Oh, Jesus, yeah, that's something you don't want. Right, so, yeah, oil is oil a hedge? Is oil a hedge? Why has oil had such a strong week when you're about to get a president that has promised to drill, baby, drill, and you've had a peace deal in the Middle East, and yet we're up 10% on the year?
Doesn't make sense.
I think I might close my short copper and actually put it into a short oil instead. Yeah, let's do that. Right, oil. I'm not going to go big. I'm going to do £3 a point. Right, £3 a point short oil, and I'm going to close my short copper that I put on as a hedge last night because I'm long all the copper miners. So we do that, and also we're short a bit of S&P 500. Oh, the FTSE's rejected. The FTSE has rejected. That's painful to watch. After all that excitement, look, there it is. So yeah, thankfully we got the hedge on in time. Thanks be to goodness. Oh, there it is, giving up the ghost, isn't it? I mean, it always looked wrong, I must admit. But yeah, what does it do now? Because we've obviously had that gap at 7 a.m. Does it give up all of that? That would be really disappointing. Let's have a little look at... So I started shorting it last night, 84.10, 84.20, 63, 64, 72. Let's cover the two of these. There we go. Right, well, no, cover one. Right, what else, Minnie? What are we missing this morning? Let's look at that big, yeah. If we get those chart on for the latest moves, let's see what's given up the ghost. N10, taking a gamble on that, up 3% this morning. Smiths, after the great numbers this week, up 3%. Persimmon, again, great numbers.
Yeah, and then we've got Bellway and Barrett Redrow, both in the housing market up. Bellway's up 1.93% and Barrett Redrow up 1.77%.
Okay, so this is interesting because, chart off, thanks guys. We're seeing a huge change in leadership in the US. Are we seeing a change in leadership here as well? Are we seeing home builders lead the indices every day? Are we seeing mining stocks lead the indices? Are we seeing oil, BP and Shell? Because in the US, it was really interesting. It was utilities yesterday that were the leader. Now, people moving out of tech and into stuff like utilities is going to start to be really interesting, right? If you're having Apple, who's already fallen from $260 down to $230, is that going to continue? And we've talked about it for how long, Mini Cooper, that these crazy outperformance.
Yeah, crazy valuations of the tech stocks in the US. I mean, how long can it actually last?
Especially with Buffett. I mean, Buffett, how much warning did you need the fact that Buffett was selling all his Apple?
Because he's got everything. He's got all his holdings in cash now, right?
That's right. Yep. Look at that. Since the 27th of December, Apple has fallen in a straight line out of the tree, right down to 228. God, I missed that one. You'd almost say that's a sign of gravity, isn't it?
What are they saying?
I tell you, it's the new haircut. I think it's going over his head. Apple falling from the tree. Or gravity. No, don't worry. We're that change of ownership.
Slow this morning.
And that's what we love you for, son. Right. Are we getting a change out of growth into value? Are we getting a change out of tech into energy? Right? It's been a huge underperformance. It might only last a day, but if it doesn't, if this is the change, then that is imperative that people like Angeline with 70% of her pension in US tech,
70%. That's strong.
70%. Aggressive, isn't it? Forget
Very
bonds. There's no bonds.
Nah, bonds are boring.
It's really worth taking a little bit of time to look at how you're positioned and how many of these ETFs are just long US tech.
Yeah.
Because that should be scary if you start to look at how many random ETFs have Apple and Nvidia in them.
And the thing to remember is in the NASDAQ, it's a market cap weighted index. So those much larger companies within the index, such as Nvidia and Apple, have a much larger influence in the price. So therefore, if one of them, as an example, if Nvidia really, really comes off, then in your NASDAQ ETF, you'd really notice that difference. Whereas if it was one of the smaller companies, you would so much less likely to notice that difference.
Let's take a really quick look at what we're talking about. So there we go. There's the S&P 500. Let's not forget, this is 500 companies.
Yep.
And if you count up the top 9, then we've got, let's check your math.
It's over 30%, just over 30.
Is it 30%? Thank you very much. So that's 13 and a half, 9 to 20, 24, 25, 27, add Broadcom 29. He's spot on. Well done, lads. 30.8%.
Yeah.
Just in US tech. And then there's 493 other companies.
Yeah. So it's really, really skewed. So that is one thing to really look out for.
And that's what makes this S&P equal weight so interesting, doesn't it? S&P equal weight. Let's get that up for you. Let's use the X trackers. We'll use the iShares for that one. Here is since how far out do we go, Minnie? It's not giving us that much, is it, unfortunately? There's the 10 minutes. There. Let's go to 1 hour chart of this. Excuse me. So there is a breakout of the S&P equal weight. And you can see that this is what's happening. More and more money is moving out of the S&P tech weight and into this S&P equal weight, because that, I would imagine, let's go to one that's been around a little bit longer. I think they might have just launched this because it's seen so much interest elsewhere. Yeah, there we go. Right, here's our... so that's actually since the middle of December. Of course, you've seen the whole S&P 500 come off. Go to a daily. Yeah, there we go. That starts to look really interesting to me. So I would much rather have, if it was the McDonald ISA, I'd much rather have exposure to this and the FTSE than I would to NASDAQ and S&P 500.
Yeah, because the FTSE 100 is also market cap weighted, but it's not as heavily based on the top percentage of companies like the NASDAQ is. So with the UK, I believe it's HSBC, AstraZeneca, BP, Shell. They are some of the major players.
You've nailed it.
Yeah.
And Unilever is quite interesting. Let's have a look to see if we can get this up for you. It'll be this one. That's not the... Yeah, it's here. Yeah, that's right. Fred's saying that was in the Christmas quiz. Obviously, that's how Mini Cooper spent his Christmas looking at this. So, yeah, here's an equal. I know it's hard to read, so I'll read out. AstraZeneca 8.5%, GSK 3%, but then you move to Shell 7.5%, BP 3%. So you got 10%.
Yeah, being oil, so therefore movements in the price of oil, which would of course affect BP and Shell, would therefore have quite a large impact on the price of the FTSE 100 index.
But it's a nicer mix, isn't it? It's all right. I've got pharmaceuticals 10.
Yeah.
Energy 10.
Different industries.
Consumer, right? Unilever is 6%. HSBC. Then you go into banking.
Yeah.
And you've got about 10% banks as well. So yeah, it's anyway. Enough on the FTSE. Yeah. Funky Gibbons saying Apple defying Newton's law. And DAX now, away from the numbers. Neil, you have pointed us out a story that we have missed this morning, and that is, where is the DAX
performance-based index?
Just explain that while I get the chart up, Mini Cooper.
So basically, with the Nasdaq and the sorry.
Yeah, no.
So I was saying how with the Nasdaq and the FTSE, how it's based on those larger weighted companies. The DAX, the way that the index is made up, it's not like that. So in terms of the way that it moves and the way it trades, it's quite different.
And it keeps the dividends in, whereas the FTSE chart takes the dividends out. That's one, one obvious change. But yeah, look at that. That is a real.
Yeah.
Which is just incredible thinking about the German economy. So after, at some point we'll look at the component breakdowns weightings in there as well, because it's not actually as big in those German autos as I thought it would be. It's more.
I thought like BMW, Mercedes. I just assumed that they would have a very, very large impact on the price.
They've been destroyed so much
because
it's actually so it's more popular. Like the chemicals and the real big industries. Let's have a look at that one. SAP is the biggest. There we go. So SAP 8%, Siemens Siemens 4% weighting, Deutsche Telekom 5%. So that's a nice bit of, they've done very well. Airbus is in there, Allianz, Munich Re, so it's the insurers, it's Merck. And the first time you actually see a car is Porsche.
And you got Porsche, Mercedes, and BMW.
Oh, sorry. Do you know what? I'm being an absolute idiot. I asked for the weightings, and that's the change. Yeah, sorry. Which is funny because that is actually a coincidence because SAP is the biggest, isn't it? Let's see if we can get the correct one.
Because the German automakers haven't had a great year due to the fact that, one, they have, well, initially had quite a large market in China, whereas that is now falling. And then in addition to that, quite a few of them have production in Mexico. And that, of course, provides a market in the US. And with the tariffs in play, that would increase the cost. And you don't know how much of the tariff which could potentially pass on to the consumer. If it would be a large amount, then that would reduce demand. But if one of the firms, such as BMW, Mercedes, did take on that higher cost, and that would eat into their profits.
Yeah. Okay, we can get the market cap there, but we just can't get the exact weighting. So at least that was the right top stocks by market cap. Yeah, and you can see that Porsche and Mercedes have been beaten up so much they're right down there. Adidas as well, it's another one. So it's a nice index. You know, I can see why it's done so well. It's just the next move after this. Right, we are moving fast towards confirm and send. Let's take one last quick look at how those stocks are doing. Antofagasta kicking on, as is Anglo's. So yeah, they're really coming in for these copper miners. That's with the move in copper itself. Then you're seeing Glencore steady up 2% and Rio's up 1.3.
I didn't mention about Barclay Group earlier with respect to the housing, but that's up 1.54%.
Yeah, Berkeley Group as well. Okay. Big European moves, Stellantis, InBev, and Porsche still. Any negatives? Let's get.
You've got.
There's hardly any negatives in the FTSE. Wow. There we go.
Just a few European names I can see on the right-hand side there, but on with respect to UK, what's that? Just five in the negative.
5, and Vodafone there reinstated as a hold at HSBC this morning. Let's see if we've had an update on tip ranks there. With that one, HSBC. I don't think HSBC are on there. No, they're not. Right, we'll try and get that price. No, Vodafone resumed with hold at HSBC. So we'll try and get that price target for you there. Well, right, that has been, my goodness, is it 27 minutes past 8?
Time flies when you're having fun.
What a morning. We'll zip into confirm and send then. Let's go. Right, haircut 100 for Mini Cooper. Let's get quizzing him. What questions have we got for him, Fred? Right, how has client sentiment evolved this week, especially after the US CPI data? So I know you've been looking at this, haven't you? So that's
a question. So we had US CPI earlier on this week, and we did see markets react very well to it. However, is this going to continue with the markets doing well? We had banking stocks this week to start off earnings season. They did very, very well. Mm-hmm. Now, with Trump getting in, Trump's coming in on Jan the 20th. I know
Monday.
Yeah, very, very soon. And there was a regulation, I can't remember the exact name, but there was a regulation which meant the US banks had to have higher capital requirements.
Of course,
okay.
Yeah.
Now, Trump is potentially looking
those.
at eliminating this. So if that was the case, that would be very good for the banks in the US. But on the whole, with respect to US CPI, I'd argue it depends what Trump's going to do when he comes in on the 20th. As an example, he wants the Panama Canal, he wants Canada, and he wants Greenland. And it's also going to see what's going to happen with the tariffs with Mexico, Canada, and China, what is actually going to happen.
Yeah.
Because he says this, but so I think the stance would be on the American economy and the outlook would be, it depends upon what happens in those cases. So it'd be difficult right now to say just off that CPI figure because the market's did pretty well. They reacted good to it.
And it was a big relief, wasn't it? Because
Yeah.
bond yields were getting to that breaking point at 4.75% on the 10-year.
Yeah. So yeah, that's how I'd answer that one. It depends upon Trump's stance on a number of political matters, and that way I believe that the markets will react rather than...
Have you been writing for the FT this morning?
Why'd you say that?
That's very interesting. So there's a great politics and policy piece, lessons from the inside for a tricky presidential transition. Now this could be you, Mini Cooper.
It's really, really hard to say at the moment because you just don't know. Even though Trump said this, you just don't know if he's actually going to go ahead and use military force to try and take the Panama Canal, which he was saying China have quite a lot of influence over. Now, I believe they have a port there as well,
Right.
Which Trump obviously doesn't like.
Yeah, and he's talking not about military, but he refused to rule out military, but it was pretty much we won't. But he will use economic sanctions to...
Yeah, so from what I saw, he ruled out military on Canada, but not on Greenland and the Panama Canal.
But he suggested that it would be economic.
Yeah, you never know with Trump.
Yeah, we had a question yesterday. What happens when Musk and Trump fall out?
Yeah,
It'd be incredible. Wouldn't
I mean,
it?
at the moment, did you see how Musk is looking to buy the US operations of TikTok, which would estimate to be between $40 to $50 billion? Now, I read on Bloomberg this morning is that there's meant to be a TikTok ban within the next few days, but Trump wants that increase, which therefore could potentially give Musk the time to buy the US operations of TikTok, which would further increase his influence due to the fact that he currently owns X. And TikTok is getting bigger and bigger, very big.
Yeah. Well, let me see. There was a story on Biden and TikTok this morning, but I'm not sure if it's made it to the newspapers yet. So I think he's pushed back the cutoff. You imagine, 50 million. Do you remember the woman who did the song "Looking for a Man in Finance"?
Oh yeah. I see that on TikTok all the time.
Yeah. So even she put out an appeal yesterday. Please don't cut. Don't ban TikTok in America. People like her you're going to make 30-40 million teenagers and people in their early 20s lose their heads. It's not the way to win the young vote, is it?
Yeah, a lot of people are going to be in tears over that. But like I said before,
Tear talk.
I personally think that with Trump getting in, that Musk is going to get given this opportunity to acquire the US operations of TikTok.
Wow. Right, now, away from the numbers, I see your question there. Start to look at Australian stocks on the IG spread bet account. Lots are listed on IG, but numerous do not offer DFB. What's the criteria a stock must satisfy to be offered as DFB?
Okay, so on that DFB, the daily funded bet. Now, for most shares, we have DFB, daily funded bet, and then for shares, we have forwards, okay? Now, in Australia, you can have leverage and you can have non-leverage shared in, okay? So on our platform here in the UK, you can see the spread bets, you can see CFDs and share dealing. Now, you may see more Australian stocks on share dealing than leverage. Now, the reason why that is because our trading desk have a number of requirements. One of the main ones being market cap. So if it's quite a small stock, okay, then it's quite difficult for our trading desk to hedge. And our trading desk always go and hedge because our business model is basically we only get money, we only make revenue off the spreads and the commissions, and we never trade against the client like most other brokers do. So we always want our clients to trade more and we want them to win. Yeah. So as a result of that, we do like to offer these stocks, but unfortunately we can only do so on share dealing rather than on leverage because of that reason.
Right. God, that's interesting. I full marks.
Thank you very much.
I'll report back to Mr. Ward.
In my performance review.
Yeah, exactly. Yeah. Yeah, I couldn't have even told you what DFB stands for. There you go. I need to go and do my training.
I could talk about the difference between the daily funded bet and the forwards and futures contracts.
Please do.
Reason I say is because I've spoke to quite a few clients lately who have been long on the indices. Let's say with the US and the UK, where the current base rates are higher than our funding rate from our side, which therefore means if you're long on these indices, you'd actually pay, and you pay overnight funding. And I've seen cases lately where I spoke to clients on the phone and on email where they're querying their overnight funding charges because they may have been on the DFB and long on, let's say, the FTSE, the NASDAQ for a month or two. But from a fees perspective, that wouldn't be the best option. You'd be better off actually trading if it was the indices and it'd be the futures. And if you were going long on the shares, it'd be the forward contracts, which you can see in the platform on the computer.
Let's have a look here. So if I search FTSE 100, okay, that's FTSE 100 cash.
Yeah.
Which one is that then?
So the cash is the DFB, basically.
Right.
We say FTSE cash is the contract which doesn't have an expiry. So if you go to like info expiry, the expiry would be like, it should show as DEC 29. Whereas on the futures, you'd actually have an expiry date. And what you can do is, if you, as an example, if you did want to hold the FTSE 100 a long time and the contract was expiring, then you can enable rollovers, and then we'd automatically roll you over, assuming you've said so, into the next available contract, rather than closing you out and just exiting that position. We close you out and then reopen you, so you don't have to do it yourself.
What I think we'll do is we'll get you back next week and we'll do a whole segment on this.
Yeah.
Because I'm definitely spending way too much on financing.
And it's interesting, I could go further into it, because if you go short, it's actually the opposite you receive.
Okay, I'll just keep shorting then. Good stuff. Mini Cooper, it's been wonderful to spend this morning with you. You can get back to the desk, get your bacon roll. The FTSE's having another go. The FTSE is now 8,970, 72, 73. So we are having another go at this FTSE breakout. We'll leave you with that and we'll go to...
79 was the number, right?
79's the number. We're getting up there. Keep your eyes on the FTSE peel. Keep your eyes on those miners. And next will be Angeline in for the Friday morning.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered. Live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
To find a list of all your open trades, click on Positions in the sidebar menu on the left. Here, you'll be able to see key information about each of your trades, including the market name, the size of your position, the opening price, the stop order you chose, and your limit order. You'll also be able to see your profit and loss. Positions are normally sorted in descending order of your latest trades. To change how your positions are listed, you can filter your view by clicking on your preferred factor, like which trades are making you the most money, by selecting profit and loss. You can edit your limit order or stop order by clicking on the figure and entering your desired number. Lastly, you can close your open trades by clicking on the close button next to the relevant trade.
I'm Ben Hemmington and I head up the sustainability function here at IG Group. IG Group pledges 1% of its annual profits and directs this to community initiatives. This is a pretty significant amount of money. We're talking several million each year. And I used to work in the charity sector, so I have first-hand experience of just how much of an impact this money can actually have if it's used wisely. In particular, we are focusing on empowerment through education, so looking to see how we can empower members of our community that are disadvantaged in different ways by providing access to quality education. It's an area of work that we're really proud of and that we're having a really excellent impact in. On the IG Group website, we have a download centre which has got lots of information about our sustainability function. Here you can find out more about our product governance, about responsible investments. We have documents around our diversity and inclusion, including a D&I statement, KPIs and targets, as well as our progress against these. You can also find a number of documents relating to how we manage our environmental impact. And then also on that download centre you can find our community impact report that talks all about our Brighter Future Fund and the impact that it's having.
Are you ambitious? A future leader? Do you think big and raise the bar? If that sounds familiar, IG wants you. We're a global fintech and we offer graduate schemes for the ambitious. You'll see everything as you rotate across the business, building your skills and knowledge as you go. Kickstart your career as a future leader at IG, the home of the ambitious.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
Hey, welcome back. A happy Friday to all you trader friends out there. It was wonderful seeing all the chats sort of melded in with Aaron's as I was messaging, trying to run across the bridge at the same time. London Bridge was wonderful today. How are you, Aaron?
I'm very well, thank you. How are you?
I'm good. Are you looking forward to the weekend?
Very much so, very much so. I'm trying to shake off this winter cold, which you might be able to hear in my voice. But apart from that, yes, very much so.
I know,
How
it's
about you?
kind of spreading, isn't it? Chris
I'm blaming
Beecham
Chris Beecham.
has had, is he monkey zero?
Potentially.
Yeah. I have to say when he came in and sat next to us, Rich and I felt a bit kind of dodgy as well. So yeah, I hope you get over it. You're going someplace special this weekend, I hear.
Yes, I'm going wine tasting, so it should be nice. I'm looking forward to that.
Nice. Which vineyard? Or which?
It's a place in Surrey called Denby's.
Nice,
So
nice.
yeah, I'm looking forward.
So whilst you're toasting away, the FTSE breakout, just whacking up my chart here, guys. Have a look at that. This is the 10-minute chart there. We saw a gap at around when it opened up, it gapped up. But also the fact that if we look at the wider chart, let's have a look at the daily chart here. Can you see the lines I've drawn there? I tried to draw it at the 8,400 and now it's 8,400, around the 8,469 handle. What do you think is behind that move, Aaron?
Well, from a sort of a macro perspective, I'd say definitely the inflation figure we saw earlier in the week for the UK was fairly welcome. And, you know, I think there's obviously a prospect of rate cuts coming in the UK. Obviously, we haven't seen that materialize with gilt yields coming down at all, but I would say that's sort of a different issue and a more of a sort of you know, governmental and economic policy issue. But in terms of the inflation figure, I think that's you know, was fairly positive, and we're seeing sort of a positive slight positive sentiment in the FTSE, which is why we're getting this little rally.
No, I mean, the thing is, I'm just looking at a wider chart here. Thanks, Fred, for the call here. The weekly chart, bring that up for you because we are seeing levels not seen since mid-May there. Do you think we could punch above that 13th of May level and head higher? I'm just trying to also see if we did go above that, where would we go? That is it. That is the level we're looking for. Do you think there's enough momentum out there, Aaron, for it to push higher?
Well, I think it depends on what we see going on with the inflation figures, and also the strength of the UK economy. If it continues to sort of plod along, or if it continues to grow, or if we see any sort of substantial shift downwards in UK economic expectations and growth, then it might not continue. And I think monetary policy will also play a key role in this. If we're seeing steadier inflation figures and we're seeing a path to sort of more rate cuts, yeah, that there could be a continuation of this.
Yeah, and of course, as we saw that CPI number, what a party reaction that Wednesday. I was on the line with Jack Maguire from that 1:30 point all the way till about 4 o'clock. And we were both messaging each other going, wow, it's not coming down. It's not abating. At this point in time, just checking in on some of the other stocks that kind of fill you in on what's happening. European stocks rising. We're seeing broad-based gains there this early Friday. And also the pan-European stocks also rising around 0.4%. We had that yield drama recently, but European government bond yields I'm seeing now have eased. Also, keeping an eye on, of course, any more mood music to these expectations, these rising expectations that the Bank of England will cut rates in February. Which out of all these are like the main drivers for next week, you think?
Well, it's an interesting one. I think obviously monetary policy is firmly on the radar and has been really since 2020. You know, we got the rate cuts from COVID and we saw some really intense hiking sort of throughout end of 21, beginning of 22 mainly. So I think that's sort of firmly in investors' radar because we've seen how markets can move when there's sort of both positive monetary policy, sort of loosening or tightening as well. We've seen markets move pretty much on expectations and sort of potential forecasts of what could happen as well. So I think that's really going to be firmly in investors' eyes going forward.
And looking at the DAX as well, because Germany has been very interesting of late and rising. Take a look. I'm going to add that to my workspace for you so you can have a better look. But Germany having really so far a pretty good start to the year. Some of our trader friends out there saying that this, in terms of European indices, is going to be the outperformer still this year. Do you share that sentiment?
Well, it's an interesting one. Germany was in a bit of a spot of bother last year, but still performed really well. You know, we take a look at their economic and political situation coming out of Germany, really not great. Governmental issues, you know, governments collapsing, and an economy which was sort of deteriorating throughout last year. And the expectations for the German economy are also not particularly strong, but I think the earnings and you know some of the companies there still are performing well, and we saw a really strong rise in the DAX. So yeah, one to keep an eye on, I'd say. Really to closely monitor. But it just shows how you know markets and economies can often diverge in their performance.
For those of our watchers who are concerned about you know the yield drama in the recent few sessions, the euro area benchmark bond yields now on track for their first weekly drop since early December 2024. You know, those figures that we saw released Wednesday, those CPI numbers, not enough to challenge the view that the Fed will remain on hold for now. So I guess that really sort of excited the market. Do you think these yields are going to, the euro area ones specifically, are going to continue to ease? I mean, you know, not too many hours ago, Aaron, you and I were conversing in the middle of the trading floor going, should we be looking at buying bonds and looking it up, remember? So
Yeah,
are we at this sort of, pause for now stage, or do you think we should still buy? What is your sentiment now?
Look, I wish I could have a crystal ball and tell you where peak yield was, and then I'd probably go and buy a bunch of gilts myself and other bonds. Look, I think it's going to be interesting to see what government policy is coming out of all these countries going forward, and monetary policy as well. So that's I think where we're going to have to see, and obviously that boils down to how inflation is doing. So it's a many pronged approach. I think we need to look at. But the UK, I think, is a quite specific example where there's been sort of bond vigilantes having concerns over sort of what the government's doing potentially. So that's more of I'd say a unique situation.
And at the moment, we are, or rather, the market's pricing in an ECB rate. This is the deposit facility rate, more than 2% at the end of this year. Is that about right too? I mean, it has fallen from earlier this week.
Yeah, I mean, we've seen the Europe cut a bit more than other nations. So, yeah, I think that, that would be sensible, all things being equal. But, I think the ECB is going to be incredibly data driven, as they all are at the moment. So it's something that we keep an eye on, and keep an eye on data as well as ourselves, to see if we think central banks' projections from swaps market are being too optimistic, because we've had various years where more cuts have been priced in, which we felt were over exuberance from traders.
We've got some questions as well, Aaron, for those listening in, away from the numbers, asking you, the DAX, could it be that companies are mainly exporters of goods and services? And I presume it be that the index, the German index, will continue to do well. I guess the thing here is what happens during inauguration, right? What happens with the tariffs?
Yeah, tariffs are going to be huge for Germany, and they're going to ultimately determine earnings, providing whether these exporters can pass on costs. So that's going to be a really determining factor. Are they going to get the same revenue and earnings either through increased costs, or they're going to strike deals, specific deals? So that's something which is going to be very, very interesting to keep an eye on. And so it's an area which I think there's going to be a lot of focus on, and that's going to be a really key area for the German market, because as the question asker noted out, that absolutely a huge export to Germany. So it's going to be interesting to see how they handle this.
And for those of you that didn't catch it, we did a really good market measures here. Rich and I are on, I believe it was Wednesday when we talked. We got Sahil. I got some of the research guys there to crunch some numbers as to what happened around the time when we had Trump's last inauguration, and he took a really good sort of broad view across assets. We've had that cut up especially, and I will put that on my Twitter and also on this live chat after this segment. Trump, yeah, I mean, that will be the big, we've been talking about this for so long, and it's finally happening. I'm seeing some caution already starting to come in. I was speaking to Jack yesterday on the volatility side of things. But do you think the bombshells might happen, during his speech, or do you think it will happen after the speech?
Yeah, interesting. I think there could be chances for both. I mean, even in speeches, prior to Trump being sworn in, past few weeks, we've seen him talk about Greenland, whether he's going to buy Greenland. We've seen him talk about all sorts of situations. So I think Trump, one thing to know about him, which we're probably all aware of, is that he will just really say what's on his mind. So it's going to be an interesting 4 years. So I would expect, basically throughout the whole presidency, from the get-go, for Trump to be quite transparent in essence about how he feels.
That's a
about the policy.
Good choice of words. Transparent.
Yeah, certainly transparent.
We're 45 seconds to the all sessions. Do you think, to the break rather, we are 6 minutes to the all sessions here. Do you think it's going to be more of the same? We had Monty talking about how he was trying to find out and crunch numbers to give us an indication as to, dollar, stronger dollar, and he came up with a tale of two halves. A stronger dollar in the first half, then weaker dollar in the second half.
Yeah, interesting. I mean, tariffs definitely could, prove to be strong for the dollar, could help dollar strength. But yeah, it'll be interesting to see the response and sort of how monetary policy affects that, I guess.
Right, hold that thought. We'll be right back after the short break. Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
I'm Ben Hemmington and I head up the sustainability function here at IG Group. IG Group pledges 1% of its annual profits and directs this to community initiatives. This is a pretty significant amount of money. We're talking several million each year. And I used to work in the charity sector, so I have first-hand experience of just how much of an impact this money can actually have if it's used wisely. In particular, we are focusing on empowerment through education. So looking to see how we can empower members of our community that are disadvantaged in different ways by providing access to quality education. It's an area of work that we're really proud of and that we're having a really excellent impact in. On the IG Group website, we have a download centre which has got lots of information about our sustainability function. Here you can find out more about our product governance, about responsible investments. We have documents around our diversity and inclusion, including a D&I statement, KPIs and targets, as well as our progress against these. You can also find a number of documents relating to how we manage our environmental impact. And then also on that download centre, you can find our community impact report that talks all about our Brighter Future Fund and the impact that it's having.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Hey, welcome back. And we are 2 minutes from the all sessions kicking off. Any key ones that you are looking out for, Aaron?
Well, I think we always look at the big names. As I've said, we've got a huge concentration within the index, and we've had that for the past few years. So we're always looking at the big names because our biggest positions in our equity sleeve in our portfolios are US equities, S&P 500 passive trackers. So they are quite a key determiner for how our equities are going to be doing for the the week ahead.
Yeah. Also, it's an interesting week, isn't it? We're going into the inauguration, but we're also kind of, we've seen really, relatively stellar results from the banks so far. Good mood music there. It really, on the macro front, at the moment, we are seeing it still being held up. We're not seeing, I guess maybe the December retail sales pointed to some tailwinds for the first estimate of GDP for consumer spending. But other than that, things seem to be still
Well,
relatively.
we had good jobs data, and then we had core inflation, which came in slightly below. So people are seeing maybe some little shift, but I agree with you. There hasn't been this catalyst for, excellence, I guess you could say,
Or like a Shockorama or anything like that. We will also be checking in on a lot of these retail data points. I love this time of year because then we'll start hearing from all the retailers. Like we got all sessions now underway, just having a look at some of the biggest movers for you. JD.com talking about retailers. I'm going to try and expand that view for you. Up 5.6% out the gate there. Rivian Automotive, another one that we are watching, up 4.5%. This EV maker beating expectations recently for deliveries. This is because it somehow or another managed to get its supply snags fixed, at least for now. And they have said, I believe, that they are looking at more deliveries than expected because of this easing of the supply snags there. Plug Power, another one that we talk about quite a bit on the show as well, is on the leaders board, top 3 at the moment on all sessions. However, keep an eye on Plug Power because this one's a very volatile stock, as you can see there, and it has seen its shares fall due to lots of different issues. One of them concerns about its constraints in the force majeure events, these constraining volume there. Going back to my watch list for you, this is the all sessions, and you can easily create this for yourself using our handy watch list tool. On the downside, we got Novo Nordisk down at the moment. These are the ADRs down almost 1%. And also 3M is down slightly, but it looks like it is risk on at the moment. Any names that you like out there, Aaron?
Well, I think it was interesting to see some of the sort of crypto names rallying this morning. So that's an interesting one. But yeah, really interesting to see JD rallying very strongly. So yeah, hopefully a good day for the markets.
Do you think we're likely to see the retailers come out? And this is both sides of the Atlantic. Do you think we're going to see a likelihood that we're going to have numbers that point towards relatively decent retail sales over the festive season, or do you think it's going to show weakness, or two tails, two sides basically?
It's very difficult to tell. I mean, yeah, it's a really tough one. Well, I think when the first parts of data begin to come out, I think we'll have a clearer picture of what's going to happen. But yeah, really tricky one to tell. But I think given some of the strong job numbers we've had in prior months, we could see some stronger retail sales potentially.
Apple, one that we talk about here a lot on the show as well, also an all session stock there. This is the 4-hour chart, but let me show you the 1-minute chart there. It is popping higher, and you can have a look at this by pulling up the 1-minute chart. But if you look at the wider story here on a weekly chart, it has come lower since the end of December, having seen some gravity there, using the pun earlier on between Rich and Mini Cooper. It's lost its smartphone sales crown in China. This is the key thing about Apple that has piqued my interest this year. And it's dropped to third, not second, but third place in China, its biggest growth market. Does this, raise alarm bells for you, Aaron?
Well, a little bit. I mean, we've also had Zuckerberg say that Apple hasn't really done anything for ages in an interview. I think it was with Joe Rogan or someone, but he was really slamming Apple's innovation and saying that they're just basically releasing the same product, or they haven't really done anything. They've just sort of cornered the market. So obviously, if they're losing sales in a region with one of their core markets, the core products, I should say, the iPhone smartphone, yeah, absolutely a concern. But conversely, look, we're all sort of reliant on Apple. I mean, I couldn't imagine not using an iPhone. I think many share that view. So yeah, I think they're pretty safe on the whole.
Yeah, there's an interesting saying, isn't it? Even if you're not an investor or trade Apple, you're likely to have an Apple product or use an Apple product through work or use a related product that's...
Same with Microsoft, I'd say.
Yeah. Right. So we are going to break, and then we'll be back with you shortly to talk about my pension. I'd love your thoughts on it, and also our traders as well. We'll have Chris or yourself back to talk about that, depending on who dials in first. Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
I'm Ben Hemmington, and I head up the sustainability function here at IG Group. IG Group pledges 1% of its annual profits and directs this to community initiatives. This is a pretty significant amount of money. We're talking several million each year. And I used to work in the charity sector, so I have first-hand experience of just how much of an impact this money can actually have if it's used wisely. In particular, we are focusing on empowerment through education, so looking to see how we can empower members of our community that are disadvantaged in different ways by providing access to quality education. It's an area of work that we're really proud of and that we're having a really excellent impact in. On the IG Group website, we have a download centre which has got lots of information about our sustainability function. Here you can find out more about our product governance, about responsible investments. We have documents around our diversity and inclusion, including a D&I statement, KPIs and targets, as well as our progress against these. You can also find a number of documents relating to how we manage our environmental impact. And then also on that download centre, you can find our community impact report that talks all about our Brighter Future Fund and the impact that it's having.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Hey, happy Friday. Chris, how are you?
Morning, I'm all right. How are you?
Yeah, really good. Counting down to the weekend already, but it's certainly a very exciting start to the session today. The FTSE, I'm sure you heard us talk about that a lot this morning. Finally, punching up towards, actually it's past that level now. That level last seen mid-May.
Finally happened. Get there in the end.
Oh, we've been talking long enough about this. So, do you think there's going to be enough momentum for it to go even further in, in the coming week?
Well, this is the thing, really. Markets have seen quite a bit of impressive bounce this week, and off that CPI really more than anything else. FTSE, partly again, maybe it's a revival to some extent of the fact it's still under-owned, undervalued globally. But it's a really, really good start to the year for the index, and doing a lot better than the US, has to be said. It's not often you can say that. And we've talked about the FTSE 100 before. We've said how it had that huge gain in the first 4 months of last year, and then it essentially didn't go anywhere for the rest of the year. And this is what you kind of see in markets, that it takes time for things to work out. Now, you can look at the global backdrop. You can say it's not that great in some ways. You can look at, say, the UK and say it's certainly not encouraging on that end either. But we are where we are. And it looks like there's enough value here to keep us pushing higher in the short term. Of course, it's only just getting back to a record high. You've got a new record high in the DAX this week, and that's been clocking them up for months. But it's nice to see at least join that club for the time being.
Yeah, and also this comes at a time when you know, the yield drama is kind of easing. Checking on some of the other movers here whilst we're on it. For those of you that have just joined the show, Glencore up a 3%, one of the big gainers. That, of course, coming after more reports about Glencore approaching Rio Tinto last year, but combining the two big copper producers. Reuters reporting discussions are no longer active, though, but there have been a resurgence of these talks. Also, having a look at some of the others, if I may, let's have a look at my watch list here. Germany 40, some of the big gainers this morning, Siemens Energy, Fresenius, and Heidelberg Materials also heading higher. What's it looking like on the French side? Let's have a look at the France 40 or the CAC 40. We are seeing gainers, Stellantis and Renault as well. So some of the car makers and car related stocks heading higher. ST Microelectronics also rising. And if you're looking for some other big movers, have a look at DFS, that's down 1.8%. That was after it said that it saw half-year profit nearly doubling on costs. However, there was a concern about its outlook. And also, William Hill, one to watch. Thanks very much, Andrew McKilvey. Evoke, seeing the 2024 profits outpacing the market view. Any names that you are watching and keen on this Friday?
Well, it's a little bit of a funny thing about Fridays in December, in January. You haven't got much in the way of trading statements, although I think we were noting that you had DFS, and for them it was a decent set of numbers, doubling of first half pre-tax profit compared to a year ago, but of course a fairly minor player in the overall picture. But it's really odd listening to the retail sales number this morning for the UK, and then saying, hearing this on the BBC and saying that supermarkets had a poor Christmas. It didn't feel that way from some of the updates we've had. No, but certainly, obviously, the figures are there. Yes, and they are what they are. So it's an interesting dichotomy. What the slightly more positive tone we've seen at least from a number of the retailers. And so far. And you're right. Heading into the Christmas festive season, we did have early numbers from Kantar saying that it looked like demand for higher end discretionary items were looking weak. Yeah, and it seems maybe that'll be more reflected perhaps if we get Air World and stuff to come through later. But it's really interesting that you're seeing such a strong performance from Europe over the past few weeks to sort of broaden it back out again. And maybe it's a reflection as well of funds that are going further out from just the US. There was a report this week about the equal weight S&P index and Invesco has, that was attracting record inflows. And it's broadening out is what you want to see, really, in this bull market. It will be the case that a lot of the gains will still come from Magnificent Seven, but it would be nice to see more stocks making fresh highs and more indices continue this solid performance. I mean, well done to the DAX. It really is really impressive. And that comes despite all this bad German data, but it looks like there's enough positivity, whether it's in the valuations, whether it's in the hope of a turnaround, the fact the ECB is supposed to keep cutting rates this year to drive this one high. So new record highs for the DAX this morning. And as you say, the CAC as well, following on behind, still a long way to go for it to recoup all these losses from the first half of last year. But a very, very solid performance to start the year. And that's the kind of thing you want to see. It's not all just about the US.
For those watching the CAC, trading the CAC, and also trading the DAX, just bringing you back to the DAX now, it's important to note that the psychological level is the 22,000 mark, and we are approaching, well, making that upward track up towards that point, and it'll be interesting to see when we get there. Many on the trading desk saying that it could be soon. Of course, it all depends on this big week coming up. Not only the inauguration, Chris, but also it comes as oil is climbing.
Yeah, it's really interesting that you've seen such a strong performance from oil prices. And it's maybe a reflection again that we're expecting more solid demand for the year ahead, a more congenial environment for drillers in the US. But that, of course, if you look at what happened in the last Trump administration, energy stocks didn't do particularly well at all. So it's interesting that you're having this resurgence in oil prices after what has been a very, very miserable year. So perhaps it's not surprising. And energy is under-owned as a sector. It's understandably unpopular given the poor performance you've had. But it's nice to see it coming back into the picture. And definitely one to watch. We've got US crude at highest level since July, I think it is, really. So pushing on towards $80 a barrel, and a real change of direction in the trend.
And it wasn't such a long time ago. I mean, it was just like middle of December when we were at around the 68 handle. And in a very short space of time, we're now talking 80 or approaching 80.
Yeah, it's just a shift really in the mood music around oil prices. So that's key, I think. Watch that one. That should help. It will help the FTSE 100. It will help oil stocks generally. So energy coming back into fashion in a way that hasn't been the case for quite some time. It's a real sea change in oil prices really over the past sort of couple of months. And that's partially as well China, resurgent demand maybe coming through there, with a lot of optimism about turnaround in the Chinese economy. Admittedly, it's not really backed up by the data, but we'll see how we go over the next couple of months, really.
Yeah, and not just that as well. The Biden administration and that the announcement about broader sanctions targeting these Russian oil producers and tankers, that also gave some support. I believe I read somewhere that the estimate now is 10%, around 10% of the world oil tanker capacity is now subject to U.S. Sanctions. Do you think that's likely to continue given we've got Trump, his inauguration next week, or do you think Trump is going to stick to his guns, as it were, and he'll do everything to try and lower the price or keep the price low at the pump? Because, I was there shocked that they were complaining about the price of the pump compared to here. I mean, petrol, fuel, gas, whatever you call it, is so cheap over there.
Yeah, it is going to be, I think, if it starts to fit, the pain starts to be felt, and it may well do, then you can expect him to push for more production. In terms of the sanctions on tankers, the pressure has to stay on Moscow. And it looks like, from what we've seen of the sort of hints from the administration, that they will continue to maintain a very harsh stance towards Russia. There's a sense before the election, it was a case of, I'll come in and I'll sort the Ukraine war within a day. And then there's also a sense that he doesn't want this to be his Afghanistan, which was what's a really, in many ways, doomed, I think, the Biden presidency, the withdrawal. He doesn't want to be seen to be cutting and running from Ukraine in a way that hands Putin the victory. And crucially, coming out of Moscow as well, have been comments that they won't simply roll over and take a deal as soon as it's offered. And they will push for a very, very, for them, of course, a favourable settlement. And that will get a very tough hearing in Washington. So I don't think you'll get a resolution very, very early. And so the sanctions will have to stay in place.
Speaking of favourable setting, Chris, are you ready? I need you. I need you, in your humble opinion, obviously we don't give advice here, but I'd like your views, because I always like different views and different takes, your honest view on my current holding in my pension. And I've been speaking to Aaron Bright about this as well. And
Is this the same conversation we were having on Monday? You're now crowdsourcing.
I'm not crowdsourcing. I'm just priming you so you can do the research the weekend, so I don't have to do it.
Oh, I see. Right.
And I was asked recently, and Rich, has been saying, oh, Angie, it's a very aggressive take. And actually, I was kind of thinking it's not aggressive, given I've taken half of my Nvidia off the table before Nvidia's last earnings, and put it into high divvy, to my mind, solid stocks that are likely, well, with WTI and Brent heading the way they are right now, not going to be too bad a hedge or diversification. So let me just show you the holdings that I have at the moment. This is around 70%. I'm going to try and put it up on my screen for you. Andrew McKilvey, many others, RSAC's also asking me, to kind of where I'm zooming in. Here we are. I'm zooming in. And I know a lot of people, but just to clarify, this is not advice. This is just me being asked a question by a lot of our trader friends. And this is not short-term trading. This is long-term. This is the pension, the Ong pension here. Eli Lilly, of course, a continuation of that GLP-1. But however, Eli Lilly recently, I know, because I pointed this out to Monkey Man, had a new drug that disappointed. So I took half off Nvidia. If you just come off that cam, I'll show you what I then put in around my 30% mark, and they are AstraZeneca, Shell, HSBC, Unilever, Relics, BP, GlaxoSmithKline for more exposure in the drug space, Diageo, which I found interesting because they had a lot in the 0% and light offering. However, I might need to rejig that one because it looks like its bigger shareholder recently was upset that it wasn't, or in this person's view, Diageo wasn't moving enough to diversify into areas where it didn't look like GLP-1 was suppressing sort of thirst for alcohol. Not sure yet how that's going to pan out. Got Rio Tinto as well and the London Stock Exchange Group. The thinking behind this are strong companies with strong dividends. So what do you think? What do you think, Chris?
I think the dividend angle is important because it's going to drive so much capital return, and they're very solid. I think if you've got your dividend payers and you've got your slightly more exciting growth stocks from the tech end of things, so it's not a bad balance particularly. If anything, I mean, you could probably argue it is fairly heavily concentrated in certain sectors, but there's quite a bit of diversification there. Just be aware that tech is going to leave you exposed to some stomach churning volatility if it does come off a bit. That's the risk, isn't it? It's wonderful being all in the Mag 7 when they do really, really well. If you have another July and August of last year, it's not going to be so much fun in the short term.
Mm-hmm. However, when you say in the short term, how about if this is kind of like 20 years?
Well, exactly. So therefore, you should be content to leave it and do as little with it as possible. I was talking with this about journalists yesterday, and just because it's January, it's new administration, you don't have to desperately make major changes to your portfolio. Spring cleaning it is always good, and the most important thing I think in many ways is just watch the allocation. So if you've had a big winner that's maybe a bigger slice of the portfolio than it was, you sort of rejig it away to make sure everything stays in balance.
So then I hear trader friends asking me, hey Ange, what is the what was your return on that sort of holding? Bearing in mind I changed up the diversification before Nvidia's last earnings. And so this is 105, so I've got it on my screen there. That is the rate of return for one of them. And the other thing I get asked as well is, this is not in any way any sort of guidance or advice. You can come off that screen now. But I'm looking at perhaps maybe adding some form of, given the week that we've had, maybe gilts. I was talking to Aaron Bright about this just yesterday, and we were looking up, ways of buying this and sort of hedging, right? But then I sat for lunch recently with quite a few strategists, and they were like, wow, Ange, if you're looking at like a 20-year trajectory, then all in equities, all in. What do you make of that view? What do you make of that view, Chris?
It's hard to argue with that view. I think it makes sense, really, from a longer term perspective. You don't need it within that kind of time frame.
Their reasoning was you're not going to be able to touch this, right?
Yeah. Now that's the most important thing to bear in mind. It does mean, as everyone was saying in the tech stocks, if you're all in stocks, you will have to go through the volatility that goes with it. I always remember the story of the founder of modern portfolio theory, the man that came up with the calculations of how you should exactly weight your portfolio. He put half in bonds and half in stocks because he just couldn't stand the gyrations. So he just wanted it was the volatility he didn't like. And this is the thing, we talk about what you should be in, but you have to remember that it is a bit of a journey as well. And if you can't stand the volatility, if it leads you to be making dramatic decisions, then you have to rejig your allocations. Because probably the best, in inverted commas, for actual highest returns is equities, but that will come with the roller coaster ride. So another 2022 won't be fun for that kind of portfolio.
Now, I guess the question that everyone's wondering up there is especially on the chat as well, we're getting quite a few comments coming through away from the numbers, saying the German UMPA ban is striking all the correct notes at the moment for the DAX. Do you think that, in the next, for example, 10 years, maybe the DAX is the way to go? Also, further diversification. We talk about regions all the time. At the moment, I'm about 70% US stocks. Aaron says that is market weight. Rich says that is crazy aggressive. What's your view?
It is market weight, but it's also, at the moment, it's exactly the right place to be. But US outperformance isn't always a given. You just don't know. That's the problem. So you might argue that the lack of knowledge means that you shouldn't go. It's a very heavy weighting. It's been the right thing to do, though. That's the problem. It's if you'd not been in US stocks over the last 10 years, you'd have missed out a lot, really. And so it's you have to take the rough with the smooth if you're prepared to take that kind of high allocation. It might be too much for a lot of people in many ways.
Yeah, this is true. Not everyone's risk appetite is the same. And certainly, the Beecham's gut risk appetite will be different from the Ong one to the McDonald one. I'm also looking at ETFs. I hear some of you asking, Ange, do you like ETFs? I am looking at ETFs because, overall, I'm finding I've spent the last 2 nights looking at this. So possibly why I'm drinking more coffee than usual. The management fees tend to be lower. And if you can find an ETF that mirrors what you like, then it tends to be easier to get in and out as well. Chris, what do you think about this strategy?
This is the expenses are the key thing. With long-term investing, so many of your returns derive from making sure that you find the best deal. And that's why ETFs, a big fan of ETFs, always have been, the low-cost element. Because if you look at what the percentage last year was, 85% of fund managers failed to beat the S&P 500. And that's before fees. So you are looking at this. If you get a tracker, it's Buffett's advice to the vast majority of people. He says, just put it in a tracker, that you're far better off than trying to do it all yourself or pay someone to do it. And that's just where the stats hold up. And the fact that so many, and looking at 3 of the great fund managers last year, they all massively underperformed the S&P. So even the greats get it wrong a lot of the time. It's a really hard thing to do. But expenses will eat away at your return. So keeping those low is vital.
What do you consider, decent, and what do you consider high, and what do you consider low?
And expenses
Mm-hmm.
or return?
Well, the fee, for example.
Yeah, the fee, we're looking at total expense ratios of what is 0.4, isn't it, or something overall. And then you're looking at active managers that will charge 2 or 3%. And compounded over time, you're looking at, if you argue that the average annual return is 9% and compounded over time, 2 or 3% taken off, it certainly adds up, to say the least. You can look up these graphs on the internet. They show you the returns before fees, a 5% return, a 10% return, and the vast difference that makes over the course of time. So you have to look for the sensible, low-cost funds.
Totally. And trader friends, another strategy that you can take as well is, for example, I've been asked, what are these funds called? So I'm going to show you my screen now. Hopefully I've blanked out the numbers because for my allocation, but you can tell by the percentages on the side. So Islamic equity fund, and then this passive UK equity fund. This is only one of my 5, for example. And the class 9, class 3, what really annoys me sometimes is, let's say I really like the top one and I want to put more money into that, but I find that I can't. It's been stopped. And then they have a class 10, for example. Everything inside, Chris, looks the same. Everything inside is exactly the constituents, top holdings, everything's the same, except the management fee has gone from 60 basis points to 75 basis points, right? So
Exactly.
Another way of doing this, guys, we have IG Invest here. Obviously, we've got IG Smart Portfolios. There's nothing stopping you looking at the constituents and then building your own based on that. And one of the reasons why I like mixing it up too is you find that, I don't know whether you've found this, Chris, that different providers have got different quirks. Like I'm now finding that, Fidelity, and yet again, this is not guidance or in any way advice, but find the provider that works for you. So Fidelity has this really easy self-select, and it's quick and easy, and I know what I'm doing. It's easy to navigate. It's probably too simple for all you professional people out there, but for me, it works in my time frame. The ones that don't work for me at the moment, and if you've got a really good provider that you can recommend, please put it on the chat, because I'd like to know. Prudential is not working for me at the moment because they don't get back. Customer service is terrible. And then I ask for any sort of paperwork. It takes them sometimes 2 weeks to get it to me. No one ever calls. So I'm not feeling a lot of love there. If you got some that work for you that you like so far, any quirks or any special sort of features that you look at, Chris, on your side?
No, I think a lot of mine is less is more with the pensions as well, particularly. So I probably don't take as much interest as I should do with it, which is a terrible thing to admit. But mine are all in ETFs, so I just tend to leave mine really, and just to get on. I think mine is mostly with IG's provider.
And also back to the markets, I guess this is the year where we've been talking a lot about M&A and IPOs on our outlook as well. Given where we are right now, and we are already, wow, it's, time flies fast when you're having a great time. It's already the 17th of January. Do you think we will still see the kind of IPO action that quite a few analysts and fund managers were talking about in the back half of last year?
Yeah, it certainly seems to be that way. I think the reflection from earnings season so far has been the commentary. They're expecting a more benign environment for deal making. So early days, yes, but it's certainly that's the expectation. And again, it's a sort of vibe of the new administration. But there's still plenty of companies, even in the UK, that's still cheap, and that's probably really still attractive to a lot of investors.
Last year, the number of IPOs was 150, and that raised some $30 billion. Are we likely to see more with Trump 2.0?
I should think so. It's that kind of environment. It just fires up those animal spirits. And you can expect, companies probably expect a fairer hearing, or not a fairer hearing, but a more congenial atmosphere for deal making. So I think I think we should expect to see a key rebound. And if equity markets hold up, that's a key driver for confidence more than anything else. If you can avoid another downturn. 2022 is a terrible year for deal making IPOs, unsurprisingly, because people just didn't, the mood just wasn't there.
It
So
almost
you need
started
rising
for a
markets
bit
as
and
well.
then just petered off, didn't it? We did
Yeah.
have a
Yeah, it
moment
did,
where
didn't it?
everyone was kind of like, it's back, it's back, it's back. And then it just,
Didn't go anywhere.
yeah. And so it'll be interesting. Certainly, I'm hearing already from the US that, the whole promise of less red tape, the whole promise of, Muskification and cutting a lot of costs, that's all going to make it much faster to get deals done. Is this going to come to pass, do you think, Chris, or is it going to just be hot air?
No, I think it seems highly likely. I'm always very wary of saying this X will happen, because you can never be sure. If things take a turn for the worst in the second half of the year, then it could all go completely, it could all just dissipate. But I think at the moment, the expectation is that you'll see quite a strong year, really. And I think the new administration plays a major part in that.
Heading into this year, just to remind our trader friends, we've already got quite a few big names that have filed with the SEC or have been talked about to be preparing to file. And I've got some of these. You can build it too on your watch list if you want to. I try and tend to write notes to myself. And Chris Beecham will tell you that if Ange hasn't had any coffee, it's almost pointless talking to her because she can't remember anything. So I tend to write a lot of notes, and you can find this facility. It's very handy. You can find it when you're making a trade or even on the Tasty platform. Let me see if I can pull that up for you. Here we are. You also have this facility on the left-hand side called the Journal on the left-hand side of the Tasty platform, which is super easy to use. If you've done well on a certain stock or you've been whacked and you want to give yourself a reminder, you just hit the new entry button at the top. You can also backtest on the Tasty platform as well, which is quite handy when you're thinking about making a trade or that perhaps you've been thinking about. So, Chris, we're going to have to head to the break soon, but one last thought as we head into the weekend for next week.
Oh,
Hold on to your, hold on tight.
Yeah, hold on. It's earnings season picks up from here, so it's going to be a bit busier, really. And you've got the Bank of Japan, so there's the potential for a little bit of a shakeout, really. But it's looking fairly solid, I think, from a price action perspective.
Right, we're going to have to leave it there because we have to go to break. But have a great weekend, and we'll see you next week.
Thank you.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at Tasty Live, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered. Live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
To find a list of all your open trades, click on Positions in the sidebar menu on the left. Here, you'll be able to see key information about each of your trades, including the market name, the size of your position, the opening price, the stop order you chose, and your limit order. You'll also be able to see your profit and loss. Positions are normally sorted in descending order of your latest trades. To change how your positions are listed, you can filter your view by clicking on your preferred factor, like which trades are making you the most money, by selecting profit and loss. You can edit your limit order or stop order by clicking on the figure and entering your desired number. Lastly, you can close your open trades by clicking on the close button next to the relevant trade.
I'm Ben Hemmington and I head up the sustainability function here at IG Group. IG Group pledges 1% of its annual profits and directs this to community initiatives. This is a pretty significant amount of money. We're talking several million each year. And I used to work in the charity sector, so I have first-hand experience of just how much of an impact this money can actually have if it's used wisely. In particular, we are focusing on empowerment through education, so looking to see how we can empower members of our community that are disadvantaged in different ways by providing access to quality education. It's an area of work that we're really proud of and that we're having a really excellent impact in. On the IG Group website, we have a download centre which has got lots of information about our sustainability function. Here you can find out more about our product governance, about responsible investments. We have documents around our diversity and inclusion, including a D&I statement, KPIs and targets, as well as our progress against these. You can also find a number of documents relating to how we manage our environmental impact. Then also on that download centre, you can find our community impact report that talks all about our Brighter Future Fund and the impact that it's having.
Are you ambitious? A future leader? Do you think big and raise the bar? If that sounds familiar, IG wants you. We're a global fintech and we offer graduate schemes for the ambitious. You'll see everything as you rotate across the business, building your skills and knowledge as you go. Kickstart your career as a future leader at IG, the home of the ambitious.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
Hello, hello. Welcome back to Market Measures. Angelina, it's great to see you this morning.
Yeah, how are you?
Well, really excited over this FTSE, but it's tested that level twice and it's dropped back.
I know. The sounds from calling out Sean Power from our trading desk and all the PCMs there all shouting earlier on going, Europe is back! We are watching this with bated breath, but you're right.
It's one day,
yeah,
and we're all...
So it is kind of not failing. It is almost being pulled back, sort of south. I'm going to put this on the screen for you and going to change that to the 10-minute chart. Just to illustrate what Rich was saying there, can you see this is a 10-minute chart? It seems to be being pulled back somehow to that 84 level.
Yeah, I wonder how the US will trade it as they come in. Is there going to be money coming into the UK now that it looks far more likely we'll get those rate cuts because retail sales, terrible. Nobody was shopping in December because they need lower interest rates.
And the housing market was also very, very weak, right? But I heard you saying with Mini Cooper earlier today, is this going to mean, we'll find out in a few hours, will this mean a gush of money flowing into like the oil stocks, the FTSE stocks, and a recalibration of diversification of assets there. We'll see. We'll see.
Right, so today we're going to look at this idea of probability of profit, right? So on the Tasty platform, there's this wonderful calculation that's given, probability of profit. Now, if we just come off the screen a little bit, I want to get my Tasty platform up so we can show you exactly what we are talking about here.
And this is very key, what Rich is about to show you, because the POP, the probability of profit, is the odds of a particular options trade making money. So it gives you a really nifty calculation.
So if you look at a trade I've set up here, this is looking at the March spider, right? So the S&P 500. If I was to sell a call vertical, going short the 605 and buying the 620, right? You can see the trade there down below. And then this calculation here, the probability of profit is 63%, right? And if I switch the legs around, if I brought that in, it goes down to 62%. If I move this one up, it goes to 64%. Today, we're going to dive deeper into this and look at exactly what that means. So this is a really useful market measure to know what do we do and what can we take from this probability of profit. So it's a crucial metric that traders often prioritize. It directly reflects the probability of achieving a positive result. However, the return on capital may be even more important as it directly reflects the potential profits and losses, especially when considering management and portfolio volatility. Unfortunately, it's not possible to get high values for both metrics simultaneously due to their inverse correlation. Now, the most straightforward way to boost probability of profit is to use further out-of-the-money options with smaller deltas. However, that means you sacrifice some of the potential return on capital. So finding a balance between those two factors is really crucial. Now you can see on the table there that as POP goes higher, the ROC goes lower.
Love it. And I love that, we talked about this, and you certainly talk about this with JJ yesterday. It's finding that sweet spot, right?
That's really it, yeah. And looking at this table, for example, shows you exactly, right, where is my sweet spot there? Is it the 575s? Is it the 580s? What's more important to you, the POP or the ROC? And run us through that.
So POP is a range based on where the short strikes are placed. The range for the true probability of profit of a trade is bound by the following formula. The highest possible POP equals 100 minus delta of short strike. Now this is also true, the true POP of a naked strangle. The lowest possible POP is equivalent to 100 minus 2 delta of short strike. This is also the true POP of a $1 wide iron condor.
So that's brilliant. That's like the whole calculation there is now explained to us, that all you need to know, is the delta, right? And that's what feeds into this this POP calculation. And there we can see, because higher deltas often come with more volatility, iron condors that have 30 or 40 delta short strikes have a very wide range of true POPs, depending on where you place this short strike. Now, iron condors with 10 or 20 delta short strikes have a narrow POP range. And there you can see the probability of profit against the delta of the short strike.
So, when we trade a typical Tasty trade style short premium trade, we tend to have a POP of between 70% and 90%, depending on the strategy and delta we select. And this is important, depending on the strategy and delta we select, because your strategy might be different. I've seen people going lower than 70 for specific reasons. So it really depends on your risk appetite as well. Although it is easy to interpret what pop is on a trade by trade basis, when it comes to multiple independent trades on, it is easy to misinterpret what the pop actually tells you, specifically regarding streaks of wins and losses.
So this table compares the probability of profit, but also the probability of having winning streaks based on your trade initial pop. Now, looking at random independent trades, as you can see, the probability of a four-win streak at a 90% probability of profit is 66%. You know, that is pretty exciting stuff. But if you go down to a pop of only 70%, then it drops fairly quickly, right? 24% chance there. So yeah, this is really, really useful, because I must admit, a lot of the trades that I put on, I'm looking at more like 35, 40% probability of profit. So, you know, this kind of really hits home the chances that you're taking there. Of course, it depends on the payoff as well. But note, although each hypothetical trade's initial pops are all high, ranging from 70 to 90, the change in probability of a streak of 3 or 4 winners in a row is starkly lower if the initial pop was slightly lower, right? So that's when you really want to play around with those legs and see if you can get as high of a pop as possible. Right, so the purpose here was to show that the probability of seeing multiple consecutive wins, which is what we're all trying to do at the end of the day, is usually much lower than people expect for the trade, even if it has a high pop. The lower the initial probability of profit, the starker the drop in probability of seeing consecutive streaks. What's the takeaways, Ange?
So, if you had to remember 3 things from all of this, it would be this. In order to boost the pop, traders may consider increasing the risk on one or both sides. However, this leads to a decrease in the potential maximum ROC, or return on capital. The higher the pop of your trade, the higher probability of seeing a streak of winners using the same trade. A pop that may seem high on its own, that's 70% to 75%, may actually have a very low probability of seeing streaks of wins. So this is very important, because we always talk about this here. Understanding this is key, because there is no free lunch, right? There is no reward. We always talk about this on IG and Tasty. There is no reward without risk. It's understanding what that relationship is, and pop gives you that.
That's it. And so the Tasty platform gives you all of these, right? And this is what's especially interesting. Chart off, thanks guys. So what's especially interesting when you're looking to put a trade on, and you're playing around with all the different metrics, then it just can be so interesting to work out what is going to give you that probability in a normal environment. Of course, when you start looking at 2 standard deviation moves, then it can get a bit tricky. But I thought I'd take that opportunity to just update the portfolio that we've got on at the moment on my Tasty, because I did take quite a few things off yesterday. It's been an incredible couple of days. I had a put vertical ratio in Apple, and that's paid off really nicely. So I took off the 245 210s and just left myself short one of the 210 puts. AMD, I'm just short the 90 puts, and that has been okay, but I was short 4, only now short 3. So just harvesting a little bit of profit.
You're legging out your profit. Is that what you mean? Harvesting your profit?
No, it's taking risk off the table,
right,
and taking advantage of the locking in the profit. On the Spider, I just put on a 595, 605, shorting that spread, shorting that call vertical. So that is for today. And we're at 591.60. And the reason behind that was I realized that was, the portfolio was pretty long delta at this point. So I wanted, if we had a pop up, I was happy to just put some short delta on there. I am just seeing we got a TK in from Queenstown in the chat as well. Very, very good morning to you. Yeah, we are. So yeah, got a bit of NVIDIA. Still got my long NVIDIA position there. So that's a call ratio from 160 up to 180 for me. And that's a call ladder. So I'm also short the 190s and the 195s. I really like that one in case we get a pop-up in NVIDIA. I'm also short the 115 puts and the 100 puts.
Just be aware with NVIDIA though, what's interesting on the options front is that looking out to end of February, even March, if you want to put up my screen, we're looking at expected move of 21%.
The IV rank has dive bombed.
Yeah, to 9.7. And so that is something so to be aware of, because we might have that pop, we might have an inauguration move, but looking out to February, those are big moves that are being flagged there.
Yeah. Good. Right. Well, I think I'm going to be leaving you soon, haven't I, Ange? That's me done for the week. You got a far smarter guest coming in next to take my seat.
We're going to have Issa talking about what's going to be moving in the coming week, both on the macro and earnings front. So stay right where you are.
Have a great weekend, everybody. We'll see you soon.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
CFD trading is the buying and selling of CFDs, or contracts for difference. As a derivative product, CFDs enable you to trade shares, indices, forex, commodities and more, without ever needing to own the underlying asset. When you trade CFDs, you trade the difference in the price of an asset from the point at which the contract is opened to when it's closed. As you don't own the underlying asset, you can trade markets that are falling as well as those that are rising. So, how exactly do you trade CFDs? Each contract has a buy and a sell price. Sell prices are slightly lower than the current market price, and buy prices are slightly higher. The difference between the two is referred to as the spread. If you think the market will rise, you would buy. This is called going long. If you think the market will fall, you would sell, known as going short. The more the market moves in the direction you predict, the larger your profits. If it moves in the opposite direction, the greater your loss. CFDs are traded on leverage, which means that you only need a small deposit, known as a margin, to gain full market exposure. So, if you wanted to open a position equivalent to 500 Apple shares, you might only need to put up 20% of the cost. Your profit or loss is calculated based on the full value of the trade, however, which could mean magnified gains, but also magnified losses. So, when trading CFDs, you should always keep an eye on the potential downside. Take care to manage your risk with stops and limits. Visit IG Academy to learn more.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Are you ambitious? A future leader? Do you think big and raise the bar? If that sounds familiar, IG wants you. We're a global fintech and we offer graduate schemes for the ambitious. You'll see everything as you rotate across the business, building your skills and knowledge as you go. Kickstart your career as a future leader at IG, the home of the ambitious.
Hey, welcome back to the week ahead with Issa Batterjee. Right, Issa's going to take us through all the key things to look out for. Of course, we have to start with the elephant in the room that everyone's been talking about for ages.
Which is
Trump 2.0.
Yes, the inauguration. So on Monday, US markets are closed. It's actually kind of a weird week for a couple of reasons. It's a bit shorter of a week in the US because you've got inauguration on Monday. It's a relatively quiet week in terms of macro events. So the only major kind of macro central bank data release thing that I would be watching out for is the normal US job stuff and the Friday Bank of Japan decision. So I think the Bank of Japan will be the only kind of market mover from a macro side, which is especially, I think, interesting after this week where you had all the CPI numbers and there was kind of quite a lot of movement. And then from an earnings side, it's a bit of a slightly bitty one where you've got a couple of different earnings. So I think Netflix is a big one that I'm watching for. There are some airlines, there are some consumer goods companies, and I guess you've got Amex as well. So that will tell you transaction volumes and payment volumes. So that will also be kind of an indication of how consumers are feeling.
Nice. Let's kick off with the first one, and particularly, I'm going to pull up the dollar basket here because, we've talked a lot about this on the show, Trump and potentially inflationary measures. I mean, we've already seen the Trump effect on the dollar, right?
Yeah.
But we had a bit of a wobble early in January. A lot of concerns out there whether this is going to transpire or not because, ultimately he wants business. Trump's all about business. He wants business to go well.
Yep.
He wants consumers to feel good and
wants
also
to cut deals.
He wants to cut deals. He wants the price of the pump to come down or stay low.
Drill, baby, drill.
Drill, baby, drill. And for companies to do well, you're going to potentially see maybe, Monty and I are talking about this, maybe a tale of two halves, maybe strong dollar first half, weaker dollar second half. What do you think?
Is that because you're expecting tariffs to come in and then as he cuts deals, the tariffs to either come away or more like stimulus coming? Is that the rationale for kind of the strong dollar then weak dollar move? Or
yeah, potentially the tariffs not being as bad as initially thought.
Yeah.
And then he's going to have to try and find some way of making the US consumer feel better, right?
Yeah.
And we all know. I mean, Rich and I thrash this out all the time, and I'm kind of saying I'm not saying that there's going to be a shock. I'm not saying that because he was like there could be a correction coming. What I'm saying is that Trump doesn't want this. I'm not political at all.
Yeah.
As you know, and the thing with him is that it's almost like he's going to do something that makes the US voter feel like you're that frog in the pan and the temperature goes up slightly. He's going to change certain things, and maybe the tariffs will pay for the cuts to tax that he's been talking about.
Yeah.
Maybe he'll tinker somewhere else, but it'll be so slow, trader friends, that the frog doesn't know it's in this pan where the heat's slowly ramping up, right?
Yeah.
Actually, that factually doesn't hold water. The frog actually jumps out.
Oh, really? You tried to slowly boil?
No, no, I haven't. I love amphibians, but not in my house.
Yeah, makes sense.
But I fact checked it. Apparently, they do jump out.
Okay, well, that's good to know. It's one of those like urban legends, I guess.
Yeah.
you hear all the time.
Yeah, frogs they react. Humans maybe not.
Yeah.
We just whack up the air conditioning. It might be global warming, that sort of thing.
Yeah. So I think just back to the US.
Back to the US.
Yeah. I think my gut feeling is it will depend on kind of how much they want to just make immediate signals of the work that's going to come. So I think there was lots of talk about whether he would do an emergency executive order on a deportation request on day one. There was also some talk about, in the Scott Bessent confirmation hearing, there was talk about the tax cuts plan, there were talks about the prioritization of American workers, and so we'll likely see a lot of signals in that direction. Do I think that is something that's going to immediately move markets? Possibly. But I actually think a lot of the dollar run up has kind of already happened. And
it's been baked in.
Yeah, I think a lot of it has been baked in already. And I guess I'm not so plugged into the US political landscape that I think I have a much better read than markets at this point. I think it's kind of a wait and see point of time. I think seeing the dollar as strong as it is, seeing the 10-year yield as high as it is, I think there's definitely not that much room to continue moving. But I guess we'll see. And I think especially things like the tariffs could be an inflationary pressure. You could imagine that a large-scale deportation program might put pressure on the labor market. That might also be inflationary. We saw that core CPI was slightly cooler than expected, but it's still pretty hot relatively. And so actually, I think in general, I think a decent amount of the move has actually run its course already. And so I think I'm kind of here waiting and seeing a bit before trying to just anticipate direction, I think.
Speaking of that as well, and inflation, I was just thinking about this the other day. I was having this chat on the escalator. The fires, is that going to have?
Yeah.
I got all the messages thankfully back from my relatives in Winnetka. They're fine. But those, staying in the...
It's really awful, yeah.
It's awful. Or even near the canyon, it's all crazy. No one knows if they're going to go back to a house or not.
Yeah.
Right?
So I think there's a few specific considerations about the fires I would be thinking about. I think one is very practically, like, loss and damage always leads to slower economic activity. So you might see at least the California economic activity being slightly cooler, but that is very localized. I think the second thing is normally you see in the run up afterwards, as you do the rebuilding work, you kind of catch up a lot of the economic damage that you had, because now you invest in construction and you're rebuilding, and that effort is generating a lot of economic activity. So I think in the long term, the kind of delta kind of washes out. I think two things that I'm trying to keep a close eye on is, number one, a lot of insurers actually about a year ago pulled their insurance from that area of California due to risks about how fire risk was being managed, considerations about water levels. And so a lot of people moved on to the FAIR plan. The FAIR is the government provided insurance plan. And I think it will be interesting to see what the losses are to the FAIR plan itself and how well capitalized it is to cover those losses. So that's one thing I'm thinking about. The second thing I'm thinking about is actually we're coming up to tax season in the US at a period of time where actually the Treasury General account needs to be in a robust state because they can't raise the debt ceiling very much before they hit the cap. And so the reality is that actually slightly lower or delayed treasury like payments due to tax being delayed might actually be a bit of a concern for the US. And so when we're thinking about when the debt ceiling clock is ticking, that might be something worth thinking about.
Yeah, there's some numbers out there that Trump's promise of these massive sweeping tax cuts would add $4.6 trillion to the deficit.
Well, it won't do it immediately. It will do it when the next round of taxes are raised. And so actually, if we're thinking about relatively how to manage spend, and we're thinking very strictly about the kind of the budget ceiling and the debt ceiling that the US has to have, that is going to be stimulatory. It's going to generate more of a deficit, but it's only going to do it later as opposed to right now. And right now, everyone is kind of counting the cents to try and work out how long they have before they hit the kind of the clock that was set at the end of last year.
Monkey Man's got a really good question, just hitting that up now. He's asking, Issa, what impact will the US fires have on global insurance?
I think it'll make it more expensive. I think that's the classic.
And also it highlights, all the insurance issues out there. I'm sure insurers have been looking at this for years now, due to climate change.
Yeah.
So all those properties, not just in high fire risk zones, but those that are coastal,
Yeah.
Those that are prone to flooding.
I think also thinking about the role of government in actually trying to be preventative of some of this risk. I actually think there's been a lot of criticism of Governor Newsom and the California state response to the fires. I think what you'll see is actually maybe differentiated premiums based on more local preparedness rather than just generalized premium increases. I think one risk in this case is it's not clear what the cause of the fire was, if there was any kind of like arson or accidental damage. I know Edison's stock was responding quite badly to some of the original the original like challenges or claims that they might have had some involvement in an electrical fire. I think those kinds of considerations also impact the way that reinsurance and insurance will be priced.
Just whacking up Edison's stock here. This is the daily chart, people, in case you're wondering. This is relating to what Issa was saying. What's also key, Issa, is that, even like more than 10 years ago when I was in LA, and you've been there too, I was thinking, why didn't they just, go and dig up trenches and make these fire breaks when it was cheap, relatively easy to do.
Yeah.
You're not really digging up anyone's homes. They got plenty of land there.
I know this is not like our psychology segment, right? But there is a well-documented phenomenon, which is that people don't like to think about bad outcomes. They don't like to plan for bad outcomes. And so then they basically mentally underestimate the probability of bad stuff happening. And so then, unsurprisingly, they underprepare. And then when bad things do happen, it resets normal expectations. And so what you find is with scenarios like fires or floods or tsunamis or any kind of major earthquake-style natural events, people's ability to plan and think about specific scenarios is extremely colored by their personal experience and the experience of their loved ones. And so what you might find is actually, like to Monkey Man's question, in LA, you might find insurance rates actually increase off the back of this fire in areas that are not exactly in the area that was impacted, because now everyone is looking there and seeing, oh wow, this can happen very close, and it can happen in places that you wouldn't expect. And so then more people try and get insurance.
So let's turn to Japan now. We've seen, recently signs that consumer inflation is probably heating up again.
Yeah, on the rise.
Because of energy costs.
And also because the wage negotiations in Japan look like they're going to result in a higher number for next year, above kind of where maybe consensus estimate was a year ago.
Yeah, and I've been looking at their numbers on their fresh food prices as well. That's rising, I think 3%.
And you can see the impact of that on the yen. There's been a real deterioration in the yen over the last kind of even 1 year and a half time horizon. And actually the side effect of that is that anything that's imported is also more expensive. And so food is, I think, a classic example where some parts of their supply chain are just very reliant on imports.
And so, do you think this will mean that, I know a lot of it is baked in already,
Yeah.
the expectation is they will raise rates to 0.5% from 1/4
Yeah.
in its coming meeting. Do you think it should be higher? I mean, there's a part of me that thinks that, you know, we see central banks time and time again not acting as fast as they should to clamp down.
Yeah, well, they have long and variable timelines, which make it very difficult.
Yeah.
I think they're going to bang the gong this time and increase rates. I think that to me is like almost entirely baked in, from what I understand, from market expectations. I think the question will be, if they do raise rates again, when will they do it? And I think in all likelihood, it will be probably not until at earliest kind of April, May. I don't think they'll raise in March. I think that's just unlikely to happen. I think they probably won't raise in May unless there's a material currency deterioration. And I think in the context of the really like rapidly rising 10-year US yield, I think the relative movement of the yen is like not that surprising. And I think if they're not raising rates, it's going to be harder and harder to defend the currency.
And for those of you trading the yen or the 225, we also have the import-export number out in the coming week. Right, Netflix.
Yes.
Very, very excited.
I'm really excited about Netflix.
Yeah, I want to know what's happening in terms of their like pipeline. I know they start streaming, you know, sports.
Yeah. So I think this has been an interesting quarter for them because they've had live streaming events. I think that is a new area that Netflix has kind of entered into, and it's an area where historically they've actually been quite averse to doing that because it requires a very different infrastructure to do that. The two major events that happened were the Mike Tyson Jake Paul boxing match and the Super Bowl, the football game that they streamed, both of which were this quarter. And so it'll be interesting to see if that's had any kind of major contribution to their activity numbers or their user numbers. I think the other thing worth really thinking about with Netflix is the content library they had. So we had a really prolonged period where content wasn't really added to any of the major platforms because you had the strikes in the US and that led to a big slowdown in content generation. But actually that's kind of restarted again. You had the second season of Squid Game. You had several other things on Netflix.
I never watched the first Squid Game because the thought just horrified me. Did you?
I think the first one definitely, the first season is definitely, if you're not prepared for what you're going into, is a pretty serious.
Oh, really?
Yeah, it'll shake you up a little bit. I think the second season, once you kind of know what's coming, I think it's less intense. But yeah, I think it'll be really interesting to see actually how much are user numbers influenced or driven by the actual novelty of the content that they're generating, as opposed to now what is quite a deep library of existing content.
I recently watched the I Am Tim, you know, the Avicii.
Oh yeah,
Netflix.
Is it good? I haven't seen it. Really? Yeah.
I mean, it wasn't sort of, you know, I mean, if you like his music, I watched it because I wanted to know what was behind the lyrics.
Yeah.
But for some bizarre reason, because I'm so busy working at IG, it keeps us, you know, at our desk. In my mind, I thought it was going to be some sales thing, and for the next concert, buy it here, right? I thought that was and of course,
but Avicii's passed away.
Everyone was saying like, why did you think they would make a documentary about this Andrew? He wasn't dead. I'm like, I don't know. I thought he was still alive. I was like, oh, you know.
Yeah. No, I loved Avicii's music, and I think I was definitely in the age cohort that was like 100% all in on Avicii, and then his death was like obviously devastating for us.
I kept the levels and SOS, and now I found out what was behind the lyrics of SOS and stuff. I had no idea.
And he like really struggled with mental health throughout his life, and drug usage as well.
We got to go to a break, I've been told, otherwise they're going to bring in the curtain and drag us out, and we'll be back. So stay there
with consumer earnings and airplanes.
Exactly. Airplanes, R6NR, you wanted to ask this question about oil prices and all of you that trade airline stocks. This is a good segment. Also, just whacking up my screen just very quickly. For those of you that want to know the Netflix impact on streaming of sport, I already talked about this way in advance because it was already tearing up and disrupting India's sports streaming space with JioCinema and everything else. Amazon as well trying to claw in on the space because they were concerned Netflix was incoming. So I will whack that in the chat, but stay there because we've got more to come.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
You can find a variety of asset classes on the sidebar menu to the left of your platform. It's now time to pick an asset class. There are 4 major types. 1. Shares in individual companies listed on global stock exchanges. 2. Indices, a group of shares measuring the performance of a particular region, exchange, or sector. 3. Forex, the value of one currency compared to another, like the pound versus the dollar. 4. Commodities, like gold, oil, natural gas, or wheat. Decide which of these markets interest you and which you know the most about. It's up to you to research the market you'd like to trade. This will help inform any trading decisions you make. You need to know the risk of trading a particular market. Markets react to events like economic releases. Next, look at the market's opening hours and how they'll fit into your trading plan. The deal ticket will let you know if a market is open or closed. Lastly, look at the costs and charges applicable. Once you're happy with your market choice, place a deal through the deal ticket.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Are you ambitious? A future leader? Do you think big and raise the bar? If that sounds familiar, IG wants you. We're a global fintech and we offer graduate schemes for the ambitious. You'll see everything as you rotate across the business, building your skills and knowledge as you go. Kickstart your career as a future leader at IG, the home of the ambitious.
Hey, welcome back, trader friends. We were grinning here because, as I was just saying, hey, tell Monkey Man that if you're going to renew your Netflix subscription, then make sure you trade the stock.
Yeah, I was just saying, like, I think whenever we're trading, we have to use all the signals we have available. And if there's a product that I am willing to give money to, that's something that I should consider if it's a buy at the right price or not. So I think if you're going from someone who's not giving the money to someone who is giving the money, it's maybe an interesting point in time to think about how many other people are doing the same thing.
Yeah, and if you see lots of people around you doing it, then it must be for a good reason, right?
Yeah, exactly. Yeah.
But I completely concur, which is why I like driving, as you guys know, lots of EVs and testing that out. Also, I used to cover the car shows in Frankfurt.
Oh, cool.
So I still get the invites and
nice,
etc. Right? I've driven the latest Defender.
Cool. Is it good?
Tested it. Yeah, it's great. What's interesting are the features inside it. Like there's a fridge in the middle compartment between you and the passenger.
It just runs off the battery?
It just runs off the battery. And then the secret compartments, if you get that model, are kind of cool too. but I'm kind of like, why do we need all these secret compartments? Anyway, that's another show. But I tested for the engine, the maneuverability, you know, what it can do, what it can't do. Lots and lots of bells and, you know, whistles. And I always say, you know, don't ever underestimate what they're putting ahead, because they're very clever, that bunch there. They're really kind of stress testing and giving us products that we are going to want in about a year to 2 years time.
Well, that's the art form, right? It's trying to not follow, it's the lead, right?
And it's the art form, because I can tell you that a year before I got my car, I asked the MD of Land Rover, I said, why would anyone need, I'm now like kicking myself because I can still hear myself asking him this. We're now good friends. I said, why would anyone need 10 USB plug points in a car?
And now you're
we
like,
don't have enough plug points in the bloody car.
That's so funny.
And you know, everyone's just plugging in because we all have so many more devices.
Yeah.
Back to
so away from cars and towards maybe airlines?
Yeah, and as if on cue, R6N, I'm pointing to the screen because we have this wonderful facility now where Issa can also read the comments.
Yes. So if I ever look this way, it's because I'm reading what you guys are saying.
Exactly. So you're going to read out what R6N is asking.
Yeah, thanks for talking about IAG and oil. Further, do you think oil has legs to run further? Thanks.
There we are. I'm whacking up WTI. And this is the monthly chart, but also changing that up to the weekly chart, because as you can see here, we are in a very short time trending up into that $80 a barrel mark, right? It's slipped back a bit, but it is very close.
We're still above 77, right? Yeah, 78.
Yeah, we are above 77. Let's see the daily chart here. Yep, the 78 handle is where we're at.
It is a really good run, especially in the context of knowing the US is just going to be expanding supply.
Yeah, totally. And also, look at how this run has been so quick. I mean, it was just beginning of December when we were at that 67 handle, right?
Yeah, also during a period where you've heard nothing but negative news about China, for example.
Yeah. Well, we had that sanctions news from Mr. B. And I just think at this point in time, you know, depending on whether or not we hear something quite like a bombshell from Trump next week, our SACs, we could have a bit more to run. I mean, unless he says something drastic, like, you know, we're going to open the shale floodgates.
Double shale capacity.
Yeah, double shale capacity. Or we're just going to, you know, promote and give licenses to all exploration, right?
Well, but it's one of those funny things where the further oil goes up, the more affordable Permian looks, and actually the much more reasonable supply it is to pull out of the ground, because even if it's slightly more expensive, the relative return you're going to get is higher.
Yeah, and those of you trading all those renewable stocks as well, bear this in mind. You know, you're not going to do yourself justice if you don't always keep WTI and Brent in view. Permian, yeah, that's a good point. All the biggest exploration companies are all digging there.
Yeah.
And I guess this also has a key link to trading airlines.
Yes.
So RSAX, I believe, has got a position in IAG. So Issa, she wants to know what your view is on oil and how that might impact IAG.
I think it's obviously a major cost input to airline companies. I think fuel is one of the most consistent variable costs that airlines have. So presumably higher oil is going to lead to more costs for them. I think the reality, though, is that we've had quite a long period of time where oil has been fairly stable. And so you might be in a situation, depending on the organization, how well hedged they are on their fuel costs. They might actually not be as responsive to that oil price as you might assume just looking at what, for example, crude oil or WTI is doing. You can see actually, wow, look at that. It's a real strong performance from IAG.
Yeah.
I think this also, to me, speaks to just the strength of the consumer, right?
Yes, and also the kind of, you know, what I call the COVID springback, right?
Yeah.
The whole kind of, we've had it now, and we're still seeing that glow, post-COVID, post-lockdown glow. transcend into the airline space, be it American Airlines.
So I think American Airlines
European.
also is riding off the back of a strong dollar. Like
Yeah.
if you're going to somewhere like Japan, for example, the cost of that holiday has taken a nosedive for you, which is great. And so given that affordability, then I think the demand for travel is just much higher. Like with that strong dollar, you can just absolutely go to places that would have been totally out of your budget in the past.
Totally. And if you've been, locked down for such a long time, and certainly last summer when I was traveling across the US, my goodness me, were the airports busy. Whether you were in DC, whether you were in Michigan, whether you were in Chicago, I mean, things were just flying off the shelves. They're able to demand $5 a bottle of water.
Wow.
It was, and yet it was still selling.
Yeah.
And you hear of people, my cousins saying, yeah, it's not uncommon to be pushed off a flight because it's been overbooked.
It's interesting though. So the earnings we've got coming up this week include EasyJet. I don't know if you can pull up the EasyJet chart, but
There you go.
I guess EasyJet is one of those airlines that is a budget airline. And so over the same period of time that you might have seen that consumer strength, you actually haven't seen quite as much strength from EasyJet. That being said, I do think it's an extremely well-run organization, and the kind of pretty ruthless efficiency that they drive towards, I think helps their margins look pretty good. And so I think I would be looking to the top line number that they publish as part of their earnings.
And also, RSAX, what is key is that almost all of these airlines are all highlighting strong summer 2025.
Yeah.
However, what I would say is, on other screens, you can underlay this. I'm just going to pull up IAG again.
Yep.
If you put this against, for example, a WTI chart, you will see that any big sudden spikes in oil will pull down these airline stocks, especially IAG, given it's so large. What you also want to look out for is if they suddenly change any mood music surrounding that 2025 summer outlook.
Yeah.
And if they say anything about oil eating into margins, that's a red flag. Anything said...
The other red flag is typically leasing costs.
Yes.
I think with interest rates quite high, there's a chance that that's a potential pressure for them.
Another big one to think about is also we talk about guardrails all the time here at IG, especially with SR as well, and psychology. If you think you've had a really good run and IAG has been on a tear, RSAX, there's nothing stopping you just taking maybe half out or maybe taking a quarter out or having a leg take profit strategy, right? That eases you out of it if you don't want to come out.
Just manages risk, right?
Exactly. That's what I've done with NVIDIA. And it's all see me tear my hair out.
Every time you take some off the table, it rockets up.
It hurts. It should hurt because otherwise you're dead. We just have
It's just like the fire we were talking about earlier. Like we don't want to think about the bad stuff happening, and so then we don't tend to prepare until it's too late.
But you have to think about talking about good stuff and bad stuff, and also airlines, the consumer space.
Yes, yes.
Johnson & Johnson, Procter & Gamble.
Yeah, and I guess I would also count American Express there and
Yes.
look at transaction volumes that we're seeing from consumers. I think those are the three big earnings that I'm looking at for next week from a consumer side.
I also like looking at MX to kind of look at that, whether or not people are pulling out and elongating their debt payback time frame.
And I think because also Amex has a slightly different segment of users to your typical Visa or MasterCard, I think it also tells you a totally different picture about like what the US population is looking like.
Yeah, totally. And it has that bird's eye view across sectors in the US. So watch out for that key element. Back half of last year, we're seeing people go from 2 months to 3 months repayment. If it starts edging that way, it might have red signals for the US economy, but if it lessens and becomes like 2 months to a month, then that's all positive news. And on that note, we're going to have to say goodbye. Thank you so much for your
That was a pleasure.
time, SR. Always wonderful having you on with us.
Yeah, and enjoy the quiet Monday.
Yeah. Have fun, everyone. Have a good weekend.
Stocks are saved, or are they? It's Wednesday, January 15th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Dylan Radigan in Milan. We have, that's Nick Batista. He's in Tucson or Mesa, Arizona, perhaps, but I think Chicago. We're here to take you through the next hour as we wrap up this trading day. Futures market closes at 5 Eastern, 4 Central. If you're on the platform or the website, come over to YouTube. Tell us what you're trading, what you think of this big reversal in stocks higher here today. If you're already on YouTube, come join us on tastylive.com, see what we're all about. Guys, 8:30 a.m. Eastern came around and CPI came in warm, but not hot. And I think that was the fear. Bond yields break down over the course of the day. Stocks are able to rally. Gold, silver surge. Oil presses $80 a barrel. That's not a problem, apparently, for the rest of the market. We ultimately see an Israel-Hamas ceasefire deal come together, but that doesn't really cause much of any sort of price action reaction. And the dollar's down across the board. This morning, before all this came out, Nick, from the stock side of things, the banks were doing quite well. JP Morgan, Wells Fargo up after their earnings releases. So XLF is posting fairly sizable gains today. Nick, let's just take a step back and start with you as our returning champion, resident guest. What do you take of this market now? Are the bulls back in town, or is there still more work to be done?
I think so. I think next week is our last sort of volatility event of the inauguration and, the changing of the guards. I think, we see this time, you have a little bit of volatility that comes into the market. You have all sorts of things that, bid up that volatility. We've had PPI, CPI, we've had employment reports, we've had all sorts of messing around in the bond market and with the Fed. And it's all kind of, even though things are not perfect, so to speak, like you were talking about CPI being kind of warm in the middle of expectations, at least the event is over. And I think that's kind of what this move today has been. I don't think we're going to continue another, 150 points over the next 2 days. Maybe we can, but I don't think that's really the move. I think it was more of just a relief. We got that out of the way. I think the next relief, or at least volatility event, is, come Tuesday when we start getting all the headlines and the press conferences with Trump, which I think are going to bring sustained volatility for the next year or so in both directions. I think it's going to be back to 2020, 2021 trading, where you could trade on both sides of the market day to day. I think that's what we're in for, which is great for us.
So volatility comes off the board today. It doesn't sound like you're a believer in that. Spot VIX, which started the week up near 22, is now back to 1610, and it's inching into that territory where simply the best thing to do is be long the market and go fishing. Not quite yet, but we're almost there. Dylan, is this just relief today? Are we just relieved that inflation isn't running away too far, too fast for us, and maybe the Fed isn't going to abandon us this year after all?
I mean, even more than that, I would say we're marking a multi-month low in the U.S. bond market after basically months of bond selling going back to the Fed meeting and really the election. I mean, I think that you're at a point where it's now for Trump to make it like this. It's like if you're wondering, like, what's the bond level for current inflation and growth? Like, here you go. If they found a level, this would be my argument. And now it's whatever the new administration actually does regarding tariffs and deportation will dictate what happens next with the bond market. And yeah, to your point is, to answer your question directly, Chris, it is a green light for the Federal Reserve to continue to do something.
When we look through the data today, what spurs on that reaction? Nick, you said that it was kind of just in the middle, and headline CPI 0.4% month over month as expected. The headline comes in at 2.9% year over year as expected. The core is a touch softer, But what stands out to me is this decrease in breadth, or improving breadth, if you will. The share of overall U.S. inflation running above the 0.2% month-over-month run rate. Because if you're above 0.2% month-over-month, then you're going to be running at a pace faster than 2.5% year-over-year, just if you were to annualize that month-over-month run rate. So right now, the components within the inflation report running above 0.2%, 51%. Okay, that's the same as the prior month. Those running above, say, a 0.4% month-over-month run rate, that's actually down. 39% of components are at that level compared to 40%. But in terms of what's causing the inflation, right, services, 49% of components are showing higher than 0.2% month-over-month. That's down from 54% last month. It's a small shift. But instead of inflation broadening out, where, we saw this throughout 2022, right? More and more categories of goods, we're seeing faster and faster rates of inflation. We're starting to see that on the other side. This isn't exactly the place where the Fed wants to be, because a 0.2% month-over-month run rate is still above the Fed's year-over-year target at the end of the day. But if we're not advancing beyond that, it means you're not in a territory where the Fed's going to look around and say, we need to raise rates. And I think that really was the fear coming into today. And it is that January OPEX week, Nick. So there's a little bit of unclenching right now in some of these flows. Tom was talking about the flows, or at least the January OPEX here at the end of last call. And I know it's going to be discussed a little bit more on the network tomorrow. But what do you think about this January OPEX right now? That December is the index month, but January is really the single stocks month.
Yeah, I mean, every year even last year, the first 3 or 4 days of trading were, the most volatile downside moves I think we had for most of the year. We had a couple little spots throughout the year that we had some downside moves, but the start of the year was volatile, and that's in part because of the changing in positioning, as Tom was talking about. You have all these market makers that are hedged for these long-term options, the delta changes. You also have this gamma exposure. And as we get closer to expiration, all that stuff has to come to zero. So in terms of like the exposure, you have to flatten out your overall exposure, and it moves so quickly. And I think that feeds into why we have been seeing these big moves over the last week or two, is because you have to have some of that positioning churn to get to a flat point after January, and then that all that stuff has to be unwound, and I think that's part of what's happening right now too. So yeah, I mean, I think I don't think this has been, if you zoom out on the market as a whole, like, it's not crazy to go down 5% from highs. Like, this is completely normal. We should be, everybody freaks out about these moves, and nobody, to the upside, the 5% upside moves are almost to be expected. From my friend group, I get texts when we go down 1%, but nobody calls me when we're up 2% to ask me if I should sell some stocks. It's almost like expected, and I think this is just a normal rotation and move. Like, I don't take it too seriously.
Our resident bear here, who is out for personal reasons today, nothing serious, he did quite well this week, to give him credit for it, right? Russell went and hit its 200-day moving average a few days ago. Ilya was able to get out of, and good thing he did on Monday, because the Russell's about 4% higher from where he got out. But it feels like, from my perspective, this has been a really great rally. We haven't learned anything new about the price action yet. The Russell is back into the congestion zone that it was in through the second half of December. When we look at the S&P 500, it remains in the congestion zone that we've been trading in for much of this year, and we still haven't broken the downtrend off the December and January swing highs. We haven't recovered through the 1-month moving average on a significant basis. The NASDAQ is still held within its downtrend from the December and January swing highs, and hasn't reclaimed the uptrend off the August and November lows. This could go either way still, but today is an indication, it feels like, that there is relaxation now in this market. Dylan, you've been a big financial markets beat reporter for a number of years. You covered the market through the global financial crisis, notably. That's how I came to know and adore you. we see here the banks today are making more money than ever before.
I feel like it's very bank positive time in America.
Yeah, is this now the beginning? Like, have we just had the correction? Banks held up better than every other sector as the markets corrected in December and into the first half of January, and now here we are. They're up 2.58% today, doing better than any single index.
I believe that is exactly where we find ourselves, sir. I think it's going to be like bonuses and profits and banking glory. It's going to be like the good old days, like back when money was money and Ferraris were Ferraris, man. I think they're going to see bankers' money flying all over town for a couple of years.
Back in my day, money was something you held in your hand, not a seed phrase you held in your head.
Now, back in my day, it was something you used to buy a Ferrari.
Mm. So, Nick, when Lambo here? Are we going back to high soon?
Well, I was just going to say, of course, I think over time you go up and to the right. But I think there will be volatility this year. I was going to mention, though, Goldman Sachs, the biggest beneficiary of the bank earnings this morning, up at 600. You got to think, to just piggyback off what Dylan is saying, is that a lot of the euphoria in this space is pricing in a lot more flexibility in the financial sector, especially with, you
got the big man who's going to throw a party in New York.
Exactly. You're going to have SPACs come back. You're going to have share offerings and mergers and all that good stuff. Like, we're ready to party, baby. The money's back.
The money party's just getting started.
Yeah, there have been some really interesting quotes floating around in the Financial Times. So, I mean, yeah, Dylan, you can verify this to Nick. We were talking about this immediately after the election over time. Like, it feels like this is going to be the grift market for a little while. People like Chamath are positioning themselves to be allies of the administration. And this is someone who's lost oodles upon oodles of money for his investors in his SPACs in recent years, basically robbing the public blindly.
Vampire. He is a vampire. Of the highest magnitude.
Forget the inverse Kramer ETF. Give me an inverse all-in pods guy ETF.
Yeah,
I will sign up for that. But crypto generally speaking is doing well here. It has a very good day today. But the banks too. So, Dylan, in what world, in your experience, when banks
I think the implication is more leverage. First, what's the number one thing that helps a bank? More leverage. Less restrictions on leverage is the number one lever you can maneuver at a large financial institution to immediately add to the bottom line, period. More leverage when there's perceived forced standard deviation risk. Ooh, that is real good money. And so you have a forced standard deviation event with the California fires, which will give you insurance pricing, mega pricing. And they're going to sell overpriced risk at higher leverage than we've seen since 2007.
Is that the fire not a short-term headwind for them, though? I mean, because you got to
know the fire's a chance to reprice risk higher
for
future, and collect more money on all Chicago PNC, New York PNC, Miami PNC, and I can sell more property and casualty than ever before at a lower regulatory requirement for capital per dollar of risk issuance at the highest price ever.
For sure, I agree with that. But what happens with the entire situation there? Like, at some point, I mean, it's
taxpayer is going to eat that. It's going to be a scandal.
Think so? So you don't think
it's going to be a scandal beyond comprehension? Oh, it's going to be such a scandal.
So it's going to be like, what was it?
They've already set the groundwork for a state because it was uninsurable by any normal math because of the regulatory caps.
Yeah.
So the only choice that the insurance companies had was to pull or sell the discounted risk, which then the state stepped in with a state entity to provide additional coverage for those who were uninsured or underinsured. But that whole racket is over.
What's the racket?
The racket is falsely pricing it property and casualty insurance at lower rates than accurately reflect the property and casualty risk of that location. Thus,
it sounds like the
keeping real
racket's
estate
just
prices
beginning.
higher. What's that?
I think the racket's just beginning. Like, are we ready to have the conversation nationally that we as taxpayers should be subsidizing people who live along coastal regions, wildfire zones in Florida,
Miami,
and California?
New York City, by the way, right in the bullseye of super risk.
Which means if we're going to continue to subsidize them, these insurance companies are going to take those risks less and less in the future. They're not going to be held by the end of a gun.
No. What you do there during the financial crisis, what you do is the irony is you actually reduce the price of the insurance and sell it to everybody because you incentivize more people buying the insurance, and then you exist in the knowledge you'll never have to pay. So you actually incentivize more building in more places and that are worse by selling cheap insurance, because your spread is 100% because the payout will not be the P&C person because it's going to be considered a national tragedy. That's the implied risk. That's the sort of moral debate. That's the moral hazard, right?
I feel pretty strongly that California, if they try to force these insurance companies to do this, it's going to bankrupt every single one of them.
That's why it ends with the taxpayer. Too big to fail. Too big to fail.
So then the insurance companies aren't going to be taking those kind of risks, which means that the only risks they have on their books are the ones that they'll never really will not pay out on. So they'll just keep collecting
wider margin deals for them.
Which means, like, we look at KIE. This is the S&P Series Trust, S&P Spiders insurance ETF, KIE. We're up a healthy amount today, 1.42%. We have taken back all of the losses since the wildfires started. We're basically at the closing high for the year right now for insurance
Like you said,
companies.
the racket's just beginning. Now everybody's going to buy hazard insurance at overpriced values, at higher leverage.
And it's backstopped completely by the taxpayers because you don't see anyone coming in and saying we're not going to.
100% margin. 100% margin.
Right. Yeah, Nick. I mean, it feels like this is a situation
Nick
like
looks with
bowling.
admiration. He's like, these sons of bitches.
I'm like,
He's like, God damn.
They got us, Dylan.
Yeah, the insurance companies have us by the balls.
Yeah,
By
they
the
got
balls.
You can't beat them. You can't beat them. What a great business! Unbelievable.
I mean, these guys.
But this is also the thing, like that really, like, you know, you guys know where I sit on the political spectrum. I don't announce it every day. People can suss that out by the things I say. But for long-time overtime listeners, you know where I reside. You know, we may not like insurance companies, but the people that staff insurance companies, these actuarials, are some of the sharpest math minds around.
They do good math. They do good math.
They know their math, right? And if they can't turn a buck, they're not going to insure it. They literally, you're only insurable if they think you will not pay out, right? Like, that's the game here. We take your money and we hope to never have to pay out on you. We don't think you're a risk, so we're happy to take your money. So when they say, no, we're not going to insure you in these areas anymore because we don't think we're going to be able to turn a buck, that is a huge, huge red flag. So who's going to fill the gap? These insurance companies that are going to, if they're either going bankrupt or they're completely insulated.
So
and that sucks, but that's a
today was
system that we
arguing
have.
there should be a private insurance exchange to compete with the legacy insurance providers, where the Nicks and the Vecchios and the Radigans can make markets selling fire risk to Malibu. And basically we can compete and participate in making, you know, and what are the chances that Nick's place in Malibu burns in the next 5 years?
0%. Nick doesn't. Like me, Nick doesn't have a place in Malibu.
Nick can't afford to live in Malibu. So if I'm back in the insurance, my premium is going to be higher than whatever AIG or any of the other ones are gonna give you. I mean, I think the
But
idea
is your Chicago insurance going up because basically climate risk is perceived, or is a global? Because right now, catastrophic global climate risk or catastrophic natural disaster risk is not part of the pricing matrix of property and casualty. It doesn't exist. It's priced at zero.
Right, because in California, they call it, the insurance companies use CAT models, they're called, right? And
but how can you look at what Los Angeles and keep it at zero?
And California doesn't allow some, like, insurers to use the risk of catastrophe for natural disasters in their modeling.
Which is the singular primary risk.
Yeah, that's the only problem.
Very odd. Very odd.
Take the primary risk off of the insurance calculus.
Close your eyes. Close your eyes and insure it.
What about what if there's a raccoon infestation? They'll pay for that. If there's raccoons in the attic, you can get a claim, but fire hurricane can't help you.
So how much, Dylan, how much you think insurance will go up just generally across
50%.
You think so? How soon? Like now?
Now.
You know, gee, then
Right
no. Wow. Okay.
I mean, certainly in the situation, like if you want to buy insurance in California, Miami, coastal, like in the target zones, for sure, 50%. I don't know about everybody, but and it's got to probably come in because it's going to be overpriced, all that, right? But if you went in today and said, I need a policy, the truth is, I don't even know how you get it. You'd probably have to go to like Lloyd's of London and get a custom contract for your land in Malibu.
Yeah.
Like, I don't think anybody would actually sell you a policy. To Chris's point, like nobody wants the risk.
I'm looking up the numbers right now on how homeowner insurance premiums changed in Pennsylvania in California over the last few years. According to economists in a paper that was put out last year from the University of Pennsylvania, the average California homeowners insurance premium increased by 33%.
But Sacramento has a regulation restricting policy price increases, which is part of the thing. Reason they're pulled it with so it doesn't matter the pricing in California because it's regulated, which is why State Farm pulled out because they were like, I can't. Their actuaries wanted to price catastrophe risk at X, and they were not allowed to do it, so they closed up.
I made a mistake. That's nationwide. In California, home insurance costs have increased about 50% since 2020. And it comes from this paper from the University of Pennsylvania. We can share this. I'll tweet this out later, how property insurance premiums are mirroring the climate risk. This was put out in September. So interestingly enough, Dylan, you say that prices are going up 50% in the natural disaster areas like in California and in Florida. They have
that validates.
So they're either getting non-renewals or the insurance premiums are going through the
roof.
Or
housing costs will come under pressure where there'll be actually discounting of it's a battle because the natural thing, what's going to happen here, not that, we can get back to this bond market, but housing is going to go up in price and regionally, even because of the shortage.
Right.
Everybody needs a house short term, but intermediate and longer term, it'll be a question of whether the value of extremely nice real estate in Miami, New York, and LA, for example, those three, gets any sort of a discount because of catastrophic natural disaster risk is higher.
Where do we
Malibu go on sale? I don't know. Doubt it.
Where do we move all the celebrities? Where are we
Chicago. Everybody's going to Chicago.
No way.
Coming to you. You're going to get priced out.
Vegas.
No, the truth is, the real answer to the question is in terms of actual people's moving is primarily as close as possible, right? So Santa Barbara is already, I'm sure, under huge pressure. Laguna, huge pressure. Like adjacent is by far. Then Texas and Palm Beach, Florida. Arizona, Phoenix, Texas, broader Southern California from Santa Barbara to San Diego, and Palm Beach.
I mean, I think I don't have any trades on in any of these insurance companies right now, but it really reminds me a lot of what we've seen around some of these isolated events with like a Boeing or a UNH. UNH dealt with the hack last year, and Boeing's, well, it's a little different. They're having planes fall out of the sky. Maybe it's more like what we see with the healthcare companies, Dylan, where these insurance companies have been given a de facto monopoly in the market, and they're too big to fail, right? So
I think that's true.
I mean, what's going to happen here, right?
Taxpayer I know that bails it out.
We've heard that the House of the House of Representatives is thinking about conditioning some of the aid to California based on various reasons, and they did this with Hurricane Sandy as well.
That's because political bullshit.
But it did, right? It's not like realistically that's just posturing, and so the taxpayers that are on the hook for these damages, and then who is going to pay for this stuff? So the question of who comes down to, is it going to be the state of California? Maybe. Is it going to be federal taxpayers, people like you and me, Nick?
California state taxpayer who's going to be irate that they're paying for Tom Hanks or whoever, some celebrities, somebody's megaplex is subsidized by the poorest people in California. It's going to be untenable. Anyway, I don't know about the markets, but I mean, for sure, I just think it'd be interesting to watch the insurance market, which is already out of spiraling by virtue of the data. And anybody who buys insurance for property or casualty knows this already. And Trump coming in, who's a real estate developer. I mean, Trump ultimately might look at this as the biggest real estate development opportunity of his life. He's the president of the United States. It's the entire west side of LA. He's going to build Trump land over the next 30 years.
The insurance company's performance kind of speaks for itself here, even though it's a little bit, blow-offy here, like many other things. But it's a day of fairly good breadth overall, right? We look at the sector performance. We covered 25 here, or at least track 25 here. Only one is down, and it's consumer staples. Not exactly a group that you look to for leadership during bull markets. So I don't know if that's necessarily a bad thing.
Yeah,
but on the other,
like your point is, it's the best time ever to be in the insurance business because you're about to get too big to fail. Plus, you're about to get higher rates.
Oh,
which is why you had a bid in the insurance companies today.
Insurance companies, they do great with higher rates, so not a problem at all, right?
And they love lower claim values.
We were talking about this, Dylan, yesterday. How we're starting to see discretionaries perk back up. I noticed that. Did I get filled here today? I didn't get filled today. I was trying to buy some calls here at XLY. Not getting filled, which bothers me. So we'll find another way to crack this egg.
And I's number one plan for the new year was short XLY.
I know. That's why I was looking to get long. Yeah. Well,
we were.
I figure you guys were right, and then it goes into this falling wedge situation, and it hits that uptrend from the August and October lows, and then the wedge is now breaking out today. So I go, okay, well, this looks like something to buy. So I tried to buy some. I couldn't buy the calls that I wanted to buy. It's pretty, it's not exactly a cheap stock, so it's not going to go in size and buy the equivalent in shares. So we'll take another crack at it tomorrow. But XLY as consumer discretionary up 2.54% today. It's at the top of the heap. The only things that outperformed it are the banks. KBE up 2.61 and XLF 2.55%. Home construction had a nice turnaround. ITB up by 2.54% as well. And, somewhat notably here, yes, it was moving up today in part because yields come back in, and a drop in mortgage rates certainly helps. But it also was moving up because of the wildfires. Home builders are going to be in there, and someone's going to have to rebuild the area. It may take a few years. Otherwise, I'm looking
30
at
years.
Well, the California, we'll see what the California Coastal Commission has to say about this.
Years.
Which is so interesting because I was just reading a report from the New York Times yesterday about the satellite imagery around these fires. And they've basically been able to figure out, like, maybe it was a campfire that was set around New Year's Day that wasn't fully put out, yada, yada, yada. But what makes this area really fascinating is that several years ago, the Los Angeles Department of Water was given a contract to take out and clear some of the brush. And while it's in the midst of clearing some of the brush, a hiker comes along and sees that they're clearing out brush in an area where there's this endangered flower. And so what happens, he sends an email to the this utilities company and says, like, hey, you guys should stop doing this. This is endangered. And the next week when he's out on his hike, he sees that they're still clearing the brush. So he files a report with the Coastal Commission in California. The project gets shut down. The company is then forced to pay $2 million in fines and shut down the brush clearing project. Incidentally enough, all those flowers are dead now because they were just burned to a crisp. All of the wildlife in that area is now dead. And Dylan, I'm thinking of that Meta project where they wanted to build a nuclear reactor to help power one of their data centers. An environmentalist group got it shut down because of some endangered butterfly that lives in the area.
The Marines out there at the Marine base near Joshua Tree, they have to stand down when there's the pissing turtle. You can't make the turtle pee because if it pees, then it dies because it dehydrates. You can't. So they give all of our warfighting Marines in their most aggressive condition at like 19 years old or 18 years old, but then they have to stand down when the turtle is sighted because you can't scare the turtle.
I don't believe you, but
No, that's why would I make that up?
but that sounds too ridiculous to be made up.
Yeah.
I'm telling you, you don't. They're like, they're like, you know, full war games in the desert, and then they're like, timeout, turtle. It's like a Monty Python.
It's like, do we want to win the war or win the battle? Like, which one do we care about? And like climate change, if you really think it's an existential crisis, you may have to chop down some areas to clear the brush so that we don't have wildfires that destroy human population centers.
They use herds of goats.
Yeah, release the goats.
Release in Laguna Beach, there was a feature of town was the goat herder was always rocking the goats, and that was fire prevention. I don't know. I mean, listen, it's easy to sit around and talk about what these people should have done or whatever. Like, it's the point is,
of course,
property and casualties getting repriced, and for Los Angeles, it's like a permanent issue. But it's a good time to own a bank, apparently, between the Trump dereg vibes and the risk markup vibes.
The banks look good. The insurance companies look good.
Catastrophic risk markup vibes.
Semiconductors are maybe trying to break out again. We saw this at the start of the year where they made an attempt to break the downtrend from the July and December highs. Today, they're poking back above that trend line again. Nick, NVIDIA's been the general in this market. I know that tariff fears are playing through here, so I suppose I should take your position, Tom's position, Dylan's position more seriously. I don't know. I want to round back to what you guys were saying at the start of the show. Am I underpricing what Trump is going to do next week? I feel like we're talking about how this is going to be a new administration with new rules and new regulations and this, that, the other thing, but do we really think it's all coming next week so soon? I feel like the odds of that maybe let's slow our roll. Why am I wrong, Nick?
Maybe it's not all coming next week, but I think we're going to have the visibility. I think it's going to be a lot of like press conferences and talking and words. And I think even the tariff stuff is more posturing than it is real. I think he just tries to shake things up. And the Greenland thing and the Panama Canal, it's all just to kind of shake things up. And I think that is the volatility. Like, I think it's the same as every other year where, politicians in general just drag their feet for ever and ever and ever. And I think Trump specifically does a lot of talking, which is, will bring about some volatility in both directions. I mean, you remember the days in the pandemic when you'd have after the market closed press conference and the futures would move 3 or 5% up or down on whatever word he said, and they'd be back to flat in overnight session. You wake up and it's like nothing happened. I think that's what's coming back to the market at least in the short term. I think that's kind of what the potential is.
Mm-hmm. Mm-hmm.
I agree with that. I mean, I think Trump's best case scenario is a daily press conference with 100 million viewers.
Those were good.
Yeah.
Every day at 4:30.
4:30 in the morning on Twitter.
Thing.
Right.
He would be live at 4:30 with 100 million. A giant audience. That's all he cares about.
Yeah, he's an entertainer at heart, that's for sure. And, that's something that he likes the attention. Guys, this just crossed my my feed here. Hindenburg Research Group, the notable short sellers, are shutting down.
Wow.
Dylan, you that's kind of a big deal. Dylan, we've been jocular in the past when big bears, get taken out to the woodshed when they throw in the towel on they're like, this is going to be a 20%
Maybe
down
this
mark.
is the top.
That feels like a big sentiment signal out there. Hindenburg Research shutting down effective immediately after their last short call or Ponzi scheme identification is filed with regulators, and that day is today.
Well, they had Carvana. Wasn't Carvana one of theirs recently? That I know they had MicroStrategy as well was in that mix.
Let's see what ChatGPT says. I'm sure they have an answer. What are Hindenburg?
I think Carvana was the most recent one, and they wrote. I mean, I think when the report came out, it was in the 250-ish, and it dropped all the way down to 180. I don't know if it was them or Andrew Left or one of the other short sellers. I just remember that being a headline.
So the most notable, according to ChatGPT, Nikola Motors. Hindenburg's research exposed alleged fraud, including the infamous rolling truck stunt, leading to a significant drop in Nikola's stock price. Adani Group, which is the Indian company, raising serious concerns about the company's financial practices. Clover Health.
That was Chamath. Of course.
Of course it was. I knew that name from somewhere, Nicholas. Renovero, I don't recall this one, the biotech company last year, and then Temenos, a Swiss-listed fintech company. I remember Nikola and Adani, and I remember Clover. I appreciate you playing into that bit. But yeah, this is like a sentiment indicator. When a famous short seller decides it's time to throw in the towel, you're probably at a short-term exhaustion point. And that worked out really well in July 2023. Who is it? Mike Wilson, the CIO of Morgan Stanley at the time, someone who turned bearish in October of 2022. Then
wrote a 70% face ripper to the upside.
And then got bullish in July 2023. Yeah. It was like, hold on a second. This guy's been on the wrong side of the move for the last 9 months, and now he's turning bullish. And then, of course, the market declined. And when did he turn bearish again? In the last week of October 23. And Dylan, we had a lot of fun with those calls. And we're like, hey, I guess it's time to get long again. So I don't know, Dylan, in your experience, do you think, let's have a philosophical discussion here. Okay. Do you think that short sellers, have they provided utility to this market? They were demonized a lot around the global financial crisis.
I mean, for sure they create value. I mean, I think that the question is, it's like asking if short sellers create value is only, I guess, a function of the degree to which prices reflect reality, because there's always some number of companies that are grossly overvalued, mismanaged, and in need of compression and a reality. And it's only in the two-sided market, as my friend Nick would say, where people that are skeptical of your grand story of prosperity and glory, that the truth can be revealed. And so I guess my bigger issue, so for sure short sellers have value, but when you got to borrow money to be right at the right time, the issue is so many short sellers are right all the time, and then it's just the wrong time. And so it's like having the hypothesis or the thesis is only the beginning of your troubles, even if you're validated in your thesis. And that's why it's sort of so ruthless, I would say, in its elimination of those who dare partake.
Yeah, but that's liquidity. Short sellers are liquidity for all the other people that want to get in at whatever that current price is. It's a valuable thing. I think being a activist short seller is much like the conversation we had on the insurance companies. It's like, sure, they're needed, but I don't want to be the activist short seller, because the tail risk is you're dead. I mean, like, you can't, you have one wrong move and the upside is unlimited and the downside's limited. Your upside, meaning the stock going to whatever number, can only be 100%. So you take 500% of risk and 100% of potential reward. And, that just doesn't, just over a long period of time with positive drift and liquidity gain.
Right. But do you think if Hindenburg's going away, Nick, is that an indication of something beyond itself? Is it just an indication short selling is hard, or is it an indication of something related to the market beyond that comment?
I think it's just short selling is hard, and especially because they need to be public to get, like a lot of the moves that they catch are due to their reporting and the publicity of it, right? Hindenburg is in their position before they put their report out saying this is a fraud. I mean, that is part of the game. I think it's just ultimately that you can never outpace the upside. The person that was short Tesla for years and years and years, how do you do that? Or even Carvana. Carvana is one where I've seen some sort of report out on accounting fraud or whatever. That stock went from $7 to $250. Even if you got in a year ago when it was at 150, you're still out 100% on the way up. It's just a hard game to get, to be in on the move at the right time.
I think you could also, you only know retrospectively, but if someone so yes, it's hard.
Yes.
But also those who have huge amounts of money and do it professionally are among the most successful, we would think. Thus, they are giant people doing it with other people's money.
Well, can I
and if
point
they
out?
can't do it anymore, where does that leave? You could argue that the market it's a top. Now you want to get short.
So in his note, Nate Anderson, the guy who runs Hindenburg Research, said that it's just time for him to move on. But I think this is, a fantastic note in here. Not talking about the returns, but in his goodbye note, he says, quote, "Sometimes this meant taking big swing and taking on fights that are much bigger than any of us as individuals. Fraud, corruption, negativity often seem overwhelming. Early on, a sense of justice was usually elusive. When it happened, it was tremendously fulfilling. It kept us going when we needed it. And boy, did we have an impact. Eventually, more than I imagined was possible, nearly 100 individuals have been charged civilly or criminally by regulators, at least in part through our work, including billionaires and oligarchs. We shook some empires that we felt needed shaking." That's the way to go out as a short seller. You guys expose so much fraud. Not only do you make a ton of money along the way, the people who are in your path are going to jail. That's true justice. And so, yeah, people like that have a place in the system because clearly regulators aren't catching them. And, how does Enron get by? How does Arthur Andersen?
And there's 1,000 frauds happening right now in front of our eyes. We just don't know which ones yet.
We haven't yet, exactly. So the work is to be done. And that, I think, leads to efficiencies in markets, right? We want efficient allocation of capital. It's like, if you can only buy something and can't sell it, you're kind of in a tough spot. If you don't have full information, well, then you're going to make bad investment decisions. So yeah, Hindenburg Research has obviously had an impact. It's had some big hits. It's had some misses, but that's every trade for everyone. And people short the market around here, don't we? Anyone ever buy a put in the S&P 500? Right, that doesn't make you evil. As it were, though, we can move around the horn. Gold, silver, as we look at this trading day here today on that daily chart, continuing to press up, again, trying to poke outside of that downtrend that's defined price action really since the election. Silver has a ripping day up 4.1%, which is nice. Copper up another 1.23%. It's been a rip this year so far, off nearly $4 a pound. But oil is where my concern lies for this bull market rally, gentlemen, because today where oil is pressing its not just highs for the year, but the highs that we saw for all of last year. And coming into today, oil had a near perfectly positive negative correlation with bonds, negative 0.96 rolling on a 5-day basis, 1-week basis, and had increased to negative 0.82 on a rolling 1-month basis. So if oil keeps going from here, yeah, this was a nice rally in stocks and bonds today, but this feels like the widowmaker, if you will. Like this could prevent us from getting much higher. Dylan, you've been the resident fader here, and I know we've gone back and forth on this in recent days.
I mean, sure is
and I think to your
tempting,
credit,
right? I would love to get a put going here, but I don't know. But I don't understand what is going on. I don't know. I don't understand.
But to your credit, you've been saying that for the last $8. You've been saying this isn't like the other types of rallies that we saw over the past year. It's not geopolitically induced. There isn't enough volatility there. You can't stand in front of it. I don't want to fade this just yet. So I'm going to ask you this question today. I've been asking you every dollar for the past few days. Is this the place to fade oil yet? Or
why?
Are you okay? Why? No reason.
I mean, at least get through Trump. At least get through
drill,
Trump.
baby, drill.
What drill, baby, drill? But you don't know. You don't know. Because you're gonna have increased. Well, you also have, because you've got that. I mean, the interesting thing, actually, when you really look at this, and why it's sort of fascinating, is actually you have the Hamas ceasefire headlines on a day when oil's up again. What is this? Another big up day on evidence of geopolitical peace, not tension. I mean, you could talk yourself into a put because
So
it's
does
so
it not
contradictory.
pass then? Is the market saying that, this is
Not geopolitical, it's economic. It's demand and inflation is the only argument.
Dylan, can a related bet? You say this is a day where there's peace in the Middle East. Can I take the under on this being lasting peace in the Middle East?
Not with my money.
Okay. All right. Just saying, listen, just seeing if you're
I'm
willing
saying
to
it
take
is the headline du jour, sir.
It is the headline du jour. Does this mean there's gonna be more risk? I think that this is really just, listen, if we're getting this Israel, Hamas, Iran, Hezbollah situation finished up, then seeing something perhaps with Russia and Ukraine also becomes likely. And if we're getting a ceasefire there, Dylan, then
week.
Our thesis on where the money goes after the sanctions end, UAE, another high
Let's
here
get in
today.
there, baby. That's the secret. That's the sidewinder. The Dubai Express, baby. It's going to be a boom town. I'm in there.
Breaking out of a multi-week range right now, multi-month range that goes back over the course of a few years. Nick, our working thesis here on Overtime is that once these sanctions end, all the Russian money that's been trapped in Europe and in Western countries, it's going to leave those Western countries. But it's not going back to Russia. It's going to go to the financial intermediaries that are basically the neutral players throughout this crisis. Your Switzerlands, your Turkeys, your Dubais. And the countries that have benefited from the sanctions, like India, because they've been refining all of the oil, those are the ones that are going to suffer. So we've had this, working thematic idea here on Overtime, like a long UAE, short INDA type of position, various exposures.
On an end of the war with Russia, end of sanctions kind of vibes.
And sanctions kind of, yeah.
It's worked swimmingly over the last couple months if you've been in this.
We're pretty proud of ourselves with that.
I like that story. I like that narrative. Seems
very
reasonable.
appealing. Yeah.
Yeah, my big macro plays for Trump's election are short European equities, EZU, EPOL, short INDA, long UAE. For the European stuff, and they're up a little bit in recent days, but they are still down from the election. Technically, are we still down from the election? Let's just confirm that. So I'm not. Yeah, we're still down from the election. Okay, good. So we're still about 2% lower than we were prior to election at EPOL. But this Polish ETF, for example, Nick, if Poland wants to sustain the war and Europe wants to sustain the war, Poland is going to have to strain its finances more than anyone else on the defense front because they're the border country. And Europe is already an overtaxed population. So if you're going to do anything to increase taxes or spending, you might have to cut social services, which could hurt economic growth, or you're going to have to increase debts, which are going to strain the finances even more. And we know how the country's finances in Europe are so closely tied to the banking sector. So Trump ending aid to Europe is going to stress European credit. And the money is not going to go into growing economies. It's going to be going to growing the defense budgets. So, Trump could be a really big game changer, but it's been playing out since November. And that's why I have trouble wrapping my head around what does next week represent beyond the official coronation of Donald Trump as the next
potential capital flight from Western Europe.
That could be the start.
And more leverage in New York on Wall Street.
More leverage in New York on Wall Street. Nick, we'll leave you the last words here today as we wind down this episode of Overtime. We're heading into the second half of the week. We've gotten through the big event risk and CPI. What are you looking forward to? Is it earnings? Is it a speech from a Fed speaker? Is it the latest airdrop for Fartcoin?
It was up 20-something% today. One of the best performing assets of 2025. So, don't sleep on Fartcoin. As the boys say, and the people in the chat, hot air rises, of course. So just be careful of anything short in Fartcoin. I'm interested in TSM earnings. You got them coming tomorrow morning. NVIDIA is near the lower end of where it's been trading. I think there's a little bit of a catch-up trade there. And if we're going to leg higher, I think it's on the backs of an NVIDIA and maybe coming from good numbers from TSM, which early reported already good numbers. So maybe that's the play. That's what I'm playing for or hoping for into the end of the week.
I still have 37 days to go. Long 260, short 270 calls here in SMH. So hopefully you are correct. But it looks like we're holding support right now. And I'm very much looking forward to those earnings. Listen, the tariffs are in play there. We've seen the headlines come out. They've weighed them down. Dylan, I suppose we have time for one more last word, and it's not going to be me. Take us home.
Oil's telling you something. Because for oil to have a bid when the headlines are peaceful, I have that. But the only thing I can say is, that the inflation is hotter than we think, and the economy is stronger than we think. It's the only possible answer.
U.S. economy is booming, at least for now.
So get ready for the super glide, baby. It's game on. My boy Nick Batiste is about to have a good time.
I'm ready to go. I'm ready.
See, he's ready.
With that, overtime is now out of time for this Wednesday, January 15th, 2025. We'll be back tomorrow, same time, same place, as we are every Monday through Thursday, right after last call. For Dylan Radigan and resident guest and our new champion, Nick Batista, I've been Chris Vecchio. We'll see you tomorrow. After a brief break, Macro Money is coming up next with Ilya Spivak. And be sure to tune in later tonight. I'll be back with Victor Jones for The Price of Truth.
Oh, yeah, it is Thursday, I think. Is it Thursday there? No, it's Wednesday. I'm sorry. It's Wednesday, 5 p.m. Central Time, a little bit after. You know what that means. It's time for Tasty Live's evening show, a little podcast. You ever a little podcast called The Price of Truth? The show where we like to explore the incentives that govern our world. And man, are there some incentives? And man, is there a world being governed right now? I have with us, as we will every Wednesday for the remainder of 2025, God willing, we have with us the one, the only, the illustrious, the splendiferous Chris Vecchio. Chris, how you doing, my friend?
I'm doing well. I don't quite sound like Bruce Wayne, but
I have one question. I have one question for you, Chris. Where's Harvey Dent? I was sucking on tailpipes last night, as you can tell.
Yeah. It sounds like you had a good time, but more importantly, like I want to put you in front of like a keyboard and a microphone and maybe get some like Ray-Bans on you and get you singing here.
You think I sound like Ray Charles? Is that the register? Is that what you're trying to say?
I got this Barry White thing going on, like a Bruce thing going on. Like, can you come serenade my wife and I over dinner tonight? Like, that'd be nice.
Right. So many jokes there. I don't think you want to go down that route.
You got an hour to kill, Vic.
A way to kick off the show somehow. Somehow that's the cold open, everybody. Welcome to The Price of Truth. I swear the show is trading related, mostly. Maybe 35% of it is. Chris Vecchio, up, and let's waste no time here. Shout out to everybody watching tastylive.com, as well as those of you watching Tasty Trade desktop and mobile applications. If you don't already have both of them, it's a new year. It's time for a new you. Go get both of them, and then hop into the YouTube chat. Bing, that just showed up on your screen. Did I get it this time? Did we time it right? I don't think we did. But if you want to be part of that chat, that will show up or has shown up or may show up at some point during the show, hop on over to YouTube. Start moving those phalanges. The more active you are in the chat, the more you're going to spoof the Google algorithm into putting our little world in front of as many people as possible. Let's save the world one view at a time. Chris Vecchio, my friend, up and away. What was it about the CPI report this morning from your point of view and perspective that the bond market seemed to swallow quite well and was obviously net positive for risk assets today?
It seems that while things are warm, they're not getting hot, which is important given our balance of risk right now. And I think that the internals of the inflation report showed that inflation is narrowing, not broadening out. One way you can look at that are the number of components of inflation that are above 0.2% month over month in any given report, and use that as the line in the sand, because above that month over month run rate, you're going to blow past the Fed's medium-term target. And if you're too far below it, then you're getting deflation. So 0.2% month over month is kind of like the Goldilocks number. As it were, if we take a look at the data right now, we've seen that the number of service categories that have over 0.2% month-over-month inflation fell from 54% of the components of the CPI report to 49%. So unlike in 2021, 22, where you saw more and more parts of, the consumer price index basket seeing inflation north of 3%, north of 4%, north of 5% in annualized terms, that's getting narrower again. So base effects that are making their way through the data series, not entirely unsurprising, but the fact that it's not searing hot and is only warm is good. And the fact that core comes in a little bit better than expected, I suppose, is the really good news. But it's January OPEX week. We just filled the gap on Monday. I'm sure you've seen Jim Carson's prophetic tweets about when that gap fill would occur.
Yeah.
And so we think about this week now in the context of how the hedging flows and the market makers are behaving around these January single stock option expiration, and you probably get a little bit of a squeeze here. Today was more about a positioning unclenched than anything else. I don't know that we've cleared out the congestion zones in any of the stock indexes that we've been looking at. The Russell's back in the range where we were for the second half of December. The Nasdaq and the S&P continue to slosh around in the chop zone, either symmetrical triangles that point to new highs or head and shoulders patterns that are still being carved out. Either way, today was nice if you were a bull, not so nice if you were a bear, but this year so far has been directionless slog. And I myself haven't laid out new capital into any equity index future trades this year so far because I just see a lot of chop ahead.
Yeah, I would agree. I don't know. When I look at that report, I don't really think inflation is a problem. The problem that it was, and I made this point with Ilya. It's a crazy thought. I don't know why I'm doing it again. I even remember after the show saying, "Why did you say that?" And here I am the next day making the point again. I think I made it with. I think I made it with you as well. That at some level, this game seems to have been for the last couple of years to align the sine waves of the real economy and the financial economy to try to keep them as perfectly offset as possible. So when you're seeing inflation in the data, you're seeing disinflation or deflation, depending on what you're looking at in price. And then when you're seeing disinflation in the data, you're sort of seeing a burst in sort of raw materials. And so the interesting thing about today, I think, is that it substantiates this dumb pattern recognition in my mind, which likely is not true, which is at the moment you start to see crude oil ripping, natty gas ripping. I don't want to say gold is ripping because it isn't, but we're still at near highs. Silver not ripping because we just got murdered, but it hasn't done any damage to silver. Still 31.5. Copper still at a decent price. My point being that it's sort of this interesting relationship I've seen over the last couple of years. When you start to see commodities on your screen, that's the point at which you're starting to see disinflationary setups in some of the data. What did you make of a warm month-over-month headline versus the cooler month-over-month core? What do you make of that, and why do you think the market is basically looking through that? Just because the energy prices they see as what? Temporary? Is that sort of what the market is thinking here? Isn't it? Shouldn't we be more nervous about energy prices running a little bit here and the potential damage that could do? Or is the market looking through that and seeing that as short term?
Probably seeing it as short term. What are the compelling reasons to think that we're going to get a big sustainable move higher in crude oil prices?
Mm-hmm.
I really do think a lot of the correction higher that we've seen in crude over the past few weeks is related to posturing around the end of the Russia sanctions for Ukraine, in part because we've already seen reports that Indian refineries are getting less traffic now. Europe has been buying from India. Russia's been sending them their oil. They've been refining it, shipping it back. And there's speculation that some of the demand is going down there. And China and India likewise are both being forced to buy oil on the open market as opposed, through the shadow fleets under the table from Russia. And so if that legitimate demand is coming back to the market, one way to explore that dynamic would be, in theory, Indian equities should be struggling. And they are. They're down since the election. Other places that would be doing well, in theory, as you and I have discussed, right? UAE, for example, Dubai as a money center. Any of the international money centers that have fade neutrality over the last few years. Once that money gets unlocked in Europe, it's going to go abroad. And so UAE, the ETF today, hit a fresh yearly high, for example. So I think the writing's on the wall there. And if you're someone who's looking at the market and saying, well, how's the economy performed in recent years when oil's been around $75, $80, $85 a barrel? The answer has been it's been fine. So are you really too worked up right now? Headline inflation driven by oil, problematic, yes, but core isn't. You strip it out, it's relatively calm. If that divergence remains for another month or two, you start to raise your eyebrows. But beyond that, again, for the past few years, oil has been range bound. The best plays in hindsight have just been simply doing, like iron condors, $10 wide of 75. And when you get back to 75, just slap back on the iron condor. Who's to say that's going to change? I don't think it will. I also don't think drill baby drill is a legitimate exercise right now, just given how our energy infrastructure is set up. Permitting reform, deregulation, that may ultimately help. But the number of wells that we can bring back on in the next 30 days is a very, very small amount, given our capacity and our advancement in refining. So this is really about tariffs. It's not about supply demand. I think it's just a legitimizing of where oil is being purchased globally. And so I think if the market, looks at this and says this is just China and India getting back above board, does it really change anything for us? Not really.
So in other words, the trading opportunity here in your mind, I sort of, maybe I'm reading this wrong. You're either reading that this is a fade for crude oil, or you're reading that $80 is not necessarily a long-term problem for inflation or the markets, and you see sideways action in crude oil. Is it one or the other, or either or? You can't call it, but that's sort of how you're seeing the world.
I think this is the normalization of where oil prices would be if there was no shadow fleet of Russian tankers making their way around the world, right? And also, I don't think it's problematic. How much further can we go? China's obviously dealing with deflation. Europe still, so is the UK. And the entirety of the global economy rests upon the weight of the weight of the U.S. shoulders, the U.S. economy shoulders right now. Stumbling my words there. And so if the U.S. economy falls off, then you have a real problem. But I don't think anyone's counting on Europe all of a sudden to get its act together, or China to learn to stimulative economic policy that addresses aggregate demand shortfalls, as opposed to what they're doing right now, which is basically all supply side reform. And Victor, if I think the economy's in the tank, you give me $100, I'm just going to put it in my pocket, save it for a rainy day. I'm not going to spend it anytime soon. And that's China's problem.
Yeah. There's so many solutions to that, though. And they're scary solutions that, in my mind, are inevitabilities. One day I'll put the aluminum foil hat on, the tinfoil hat. We'll talk about it.
All right, Thanos. I know you want to snap your fingers and make everyone disappear.
No, that's not it. It's definitely not it. But if you have a digital currency, and I'm giving out stimulus, there are lots of things that I can now do with that digital currency. I can say it has an expiration limit. So there's, by moving to a digital yuan and needing to distribute stimulus and having a problem where people are shoving it in their bank account, I just can envision so many ways that you can now change the way stimulus works to ensure that money makes it into the economy or into demand generation in some way, shape, or form. And I think that's an inevitability, like globally, but more on that later. Let me ask you, what do you think is the reason they pound? Maybe the reason doesn't necessarily matter, but I was in a way surprised that vol